What's good? What's up for everyone watching this on the replay? I hope you're having a great Sunday. Hope you had a good 4th of July. In this stream, we're going to be looking at some stocks to potentially buy this week because the last week we had a massive downtrend in some of our favorite companies. Some of the high growth, high AI beneficiary stocks got hit hard on Friday, like our main Powell Industries, AppLovin, Comfort Systems, all down like 5, 6, 7%. Meta was down 5, InnoData, Amphenol. So there are some honestly good buy the dip opportunities out there, and that's what we're going to be looking for in this stream. But before we do that, let me start off by going over all my portfolios. I love being fully transparent. It's been a while since I've streamed, so I'm glad to be back. Hope y'all had a good 4th of July. So here is our dividend only portfolio. This is our portfolio where every stock in here pays a dividend. I love companies that pay dividends, but companies that have very low yields, because I don't want super high dividend yielding stocks right now for my age. The higher the yield of a stock, generally the less total returns it gives you a year. So ideally, the sweet spot is like stocks with under a 1% dividend yield. They still have a good dividend yield, but they give you good stock price appreciation as well. And here's my lifetime percent change on every stock. So like Google, 0.5% dividend, United Rentals, 0.5%, CEG, 0.7, Meta, 0.6. Actually, Meta is one of my favorite stocks to potentially look to buy the dip on. Just on Friday, they were down 5% on Friday. The S&P is supposed to give you 8% a year, so it lost like half a year of gains technically in one day. Honestly, Meta is a steal of a deal. They're kind of just being hurt right now because of how much they're spending on AI, but that's not scaring me out of Meta. So yeah, that's our dividend-only portfolio. We also have a Roth IRA. It actually did really good this past week and month because it's a more defensive, healthcare-oriented Roth IRA. Only got 4 stocks in here. Oh, like our Care Trust REIT, check this out. This is a real estate investment trust. These companies have to pay out by law 90% of their taxable income in the form of a dividend, or else they have to pay the 21% corporate tax on it. So they're literally they're incentivized to pay out a lot in dividends. So I only have $1,000 in the stock, but we're getting a nice little $9 dividend from them. Oh yeah, HCA Healthcare as well. This is the largest non-governmental hospital group, and here's our lifetime change on every stock in here. InnoData has been our real good performer. That's one I'm potentially maybe even looking to buy more shares on. So yeah, that's our Robinhood portfolio. Hey, what's up, Miles, Matt? What's up, everyone? Tommy and Looney, Rolando, good morning. Hope everyone had a great 4th of July. We're just looking at stocks to buy this week. So here's our Webull portfolio. Here's our open profit and loss in the top left. So all time, we are up 32% or $4,900 in here. And here are all our totals, or our top stocks by total equity. So AMD is our largest holding, then Futu, then Dave. We're almost at a 400% return on Dave. Like literally, I only put $313 into this stock, and it's a $1,500 position. I can't believe it. So sometimes like you don't even have to allocate a lot of money to a stock. Like same with InnoData. I put like less than $300 into this stock. The trick is whenever you put a little amount of money into a stock, don't sell it even if you're up 100%. Like I'm up 100% of the stock. It's still such a tiny position for me that it's not even worth it to trim. So yeah, that's our Webull portfolio. Oh, here are our newest purchases in their exact order. So we've bought Rollins, Moeller Industries, CF, and Netflix. These are our 4 most recent purchases that we've done. These are all of our most recent purchases in order. Like 2 months ago, we were loading up on Uber, Microsoft, AppLovin, AbbVie. AbbVie's been a great healthcare dividend growth stock. So, yep, that's our Webull portfolio, up 32% all time. And finally, this is our main portfolio. This is our Moomoo account. If you look in the top left, it is called Buy and Never Sell portfolio, because once I buy a stock in here, I'm actually not allowed to sell it. So we're going to diamond hand it for the long run. Even though I'm up like 800%, 300%, I'm not trimming or selling even one share because it's a experimental portfolio. So year to date, actually, since January 1st, we've actually smoked the S&P. S&P's up 9.7 and we're up 62% just from our boring strategy of holding 6 companies. Like I've never done options or crypto or day trading. Like I argue that you can get better returns than all those speculative traders just by literally holding on to great growth companies for the long run. So yeah, these are all the stocks that we own in here. These are all S&P 500 companies except for Powell Industries. So yeah, and that it's really these AI beneficiaries that fell hard on Friday. Like Powell was down 7, Comfort Systems was down 7. So yeah, hope everyone's having a great day. So yeah, that was our portfolios. Now I want to deep dive into the stocks that you guys said. Someone's been saying Meta, and that's the one I honestly wanted to start the stream with. Meta, in my opinion, is a very good deal just from a risk to reward point of view. They're being hurt right now because they're spending too much on AI, but they just had something where Meta is actually going to start a cloud business where if they have so much excess compute, they're going to turn into a cloud company and sell it to other companies. MediaTek secures Meta as second largest customer. Well, where is this? Yeah, Meta develops cloud infrastructure business, Meta Compute, to monetize AI compute capacity. So if they have all this excess capacity that they're not using, then they could just sell it off. Just like the same thing AWS and Google Cloud does, and they have like 30% margins on that. So anyway, even Morningstar says Meta is undervalued and unmatched user scale across its family of apps, WhatsApp, Instagram, Facebook, Threads, AI-driven improvements in ad monetization, and the potential to leverage excess compute capacity will drive long-term value growth, and I totally agree. And just from a simple point, like valuation point of view, I don't see Meta getting much cheaper. Meta is literally trading at 18.4 times next year's net income. I don't see Meta at a 15 or a 16. So not financial advice. I think the bottom's pretty close on Meta, or else we're going to have some historic dip on a Mag 7 company at a 15 forward PE. I mean, I just wouldn't believe it. So here's their daily active users. Yeah, pretty much half the world is on a Meta app once a day, 3.54 billion daily active users. And check out the revenue growth. This is the fastest growth rate they've had in a long time. Revenue's up 33%. And I agree with Morningstar. I think ads are going to make the return on ad spend even better. So their ads are going to be more profitable for Meta. But here's the one thing investors are questioning, but I'm not getting scared out. Meta makes $22 billion a quarter. And right now they are spending over $30 billion a quarter, and they just projected to spend over like $35 billion for the next 2-3 quarters in a row. So they're spending more than they're making, and Meta now has a net debt position for the first time ever. But that doesn't matter to me. With revenue growing 33%, then building out the cloud business, and they have an 85% market share on smart glasses. I believe everyone's going to get into the smart glasses game. I love the Meta Ray-Bans. They were the first to the market, and you get a nice dividend, a 0.4% dividend, 9% payout ratio. Morningstar says this is an $800 stock, and it's $500 today. I'm totally biased because I do own Meta. Yeah, and they're just now introducing ads onto Threads and WhatsApp after they acquired WhatsApp and said, after the original slogan was no games, no gimmicks, no ads ever, now they're putting ads on WhatsApp. But that should be a nice earnings tailwind for us as an investor. So yeah, I'm up 10% on my shares. All right. Next up, I'm on a brokerage. Oh, watch out for these people in chat here. Yeah. Hey, what's up, Caden? What's up, everyone? What's up, Matt? Good to see everyone. Micron Technology still a good dip. Well, you know what? Let's go over Micron real quick. Here's why it's actually tough to be bearish on Micron. This is your huge memory shortage. If you've heard about this huge RAM, SSD, hard drive shortage that's leading iPhones, Xbox, PS5 prices to go up in prices like crazy. Let's see. JP Morgan. Okay, can we get some, Micron attributes memory supply shortage to 2023 customer pricing pressure. Okay, well, anyway, Samsung sees 20% DRAM price hike for Q3. So anyway, this stock really trades off the whole cycle of like the commodity, but look at this. Here's why it's hard to be bearish and why you certainly don't want to short this company. Micron trades at 6.7 times next year's EPS. Here's the actual net income or EPS forecast. They're supposed to make $31 of EPS next quarter and then $34 the quarter after. EPS has never been close to $30 before. Like this quarter was a record, $12. There is still hundreds, if not thousands of percent of EPS growth still happening to Micron just this year. So that's why you really value them off next year's PE. And at a 6.7, I feel like this isn't a peak bubble valuation. Like this could still stretch up to like a 10 or something, send Micron up another 30-40% or something. You know what I mean? So, and they have a dividend too. But here's what Morningstar says. They're overvalued. While the AI-driven memory pricing upcycle and soaring high bandwidth memory demand provides robust near-term growth tailwinds, the inherent commodity-like nature of the industry and looming risk of a steep cyclical downturn driven by future capacity gluts requires significant caution. So basically, they're saying 2027, 2028 is going to be peak ever EPS for Micron. Again, they sell RAM. They should not be selling RAM memory SSDs at a 60% net margin. So obviously, the EPS is going to come down in a few years, but maybe the cycle will last longer than expected, and that could maybe be what continues to send Micron up higher. I don't know. That's why it's hard to be bearish. You know what I mean? Hey, Dino, what's up, dude? He said Palantir, one of my absolute favorite stocks in the market. Not financial advice. This stock will impress you, and if it doesn't, feel free to hit the dislike button or something. What is this? Palantir CEO warns enterprises against sharing data with OpenAI. Anthropic, huh? Well, anyway, let's go judge Palantir off their fundamentals. They're so impressive. Half of their revenue comes from the government, 52%. So many police stations, the military, the Air Force use Palantir, the Pentagon, that grew. This government business grew 76% year over year. That is the fastest growth rate on the entire screen. Like the growth rate is growing on their government business. And not just that business, but also the commercial side with S&P 500 companies like Google and GE. That grew 95% year over year. It literally doubled year over year. That is why Palantir is a beast. And this is organic. Like they didn't acquire a company to get this 95% revenue growth. Here's what the analyst expected versus what they actually reported. The orange line's what the analyst expected and the blue line's what they reported. That's ridiculous. Beat on net income every quarter. And look at this margin expansion. Net margin went from a 24 to a 53. So for every $100 that comes in, they keep $53 after tax. It's just ridiculous. And this is a literal fortress of a balance sheet. Literally no debt. Absolutely no debt, and $8 billion of cash. And their cash pile just grows every quarter because they don't owe anyone any money, and they make $900 million of free cash flow, $800 million net income a quarter now. So that just goes straight to the cash pile. And that leaves them so much room to reinvest in the business, do share buybacks, do dividends, all without having to dilute you or issue debt. So let's see if there's any more news. Palantir announced a strategic partnership with NVIDIA for U.S. government agencies. Palantir expands partnership with Surface Mobility. Anyway. Analysts position Palantir as critical infrastructure for AI adoption. Well, anyway, what is this? Yeah, or what app? This is a brokerage, by the way. Some people are asking. It's where you buy and sell stocks. They ask for a bunch of information because you pay taxes. But if you'd like to get this brokerage, I have it linked in like my profile, like description bio there. So it is an affiliate link too, so it helped me out. So Matt says, I'm debating starting a position in Visa or CEG. Yo, both of those, in my opinion, are great. Oh, wow, Visa's had a nice little recovery. We've been pumping Visa. You know what? Every time you swipe your Visa credit card, they basically collect a royalty. Simple metric here, if we just go to Visa's net margin, it's a 53%. So for every $100 that comes in, they keep $53 after tax. They're collecting royalties. So Visa, MasterCard, and 140 plus launch open USD stablecoin. So maybe Visa could get exposure to crypto via crypto card. Visa commands 98% market share as crypto card deposits exceed 10 billion. Well, anyway, that's something to look into because I heard some people talking about that in my Discord. Visa is one of the few plays to get exposure to like crypto credit cards or something. Anyway, look at this right here. Again, we saw the margin. The revenue was 11 billion this quarter, grew 17%. Nice double-digit growth. So revenue's 11 billion. They keep after tax 6 billion on that. So yeah, they really do have a 53% net margin. It's a fundamentally sound company. You get a 0.7% dividend and check out the dividend every year. They grow it way faster than inflation. So you're getting paid more and more every year. They do share buybacks as well. And look at the valuation. Even after this rally, I think they're going to continue to climb. Only a 26 forward PE. That's like an S&P 500 multiple. That can easily stretch up higher. So, and look at the net income forecast. Net income is supposed to hit 6.45 in 2 quarters. Net income has never been close to 6.45. This was a record quarter. Check that out. It was 6.02 billion. There is still a lot of EPS growth on Visa to come. So I can see why they've done so well. And I could honestly just see them continuing to do well. But maybe I'd wait for a little bit of a dip to buy into them because they're at like a new like multi-month high right now. But if I was a shareholder, definitely don't sell. They're going to go higher, I think. No financial advice, of course. So what's up, Tommy says, can you do Uber stock? Yeah, let's do Uber. And sorry, I know I'm a little behind here. I do apologize. Yeah, people are asking what app. This is, again, brokerage I'm on, LinkedIn profile, like description bio there, if you want to use my affiliate link. But you can just type into your Google. It's a brokerage called Moomoo. They ask for a lot of information because it's a brokerage. But anyway, here's Uber Technology. If you want to use my affiliate link, sign up with that link. If you deposit like $100, you both get like a free like stock or something. So anyway, here's Uber Technologies. I just bought this stock as well. Here's my position. I'm up a little bit, but I got 12 shares. They were just in my cost basis a week ago. So here's why, in my opinion, Uber is honestly a great stock to potentially look into buying, not financial advice. They just are a money printer. What is this right here? Uber acquires 11 million shares of Neutron Holdings. Uber terminates Waymo. Okay, anyway. Let's deep dive into Uber stock right here. This company grows like a beast. Morningstar says they're undervalued. Robust network effects from its massive global scale, user base, expanding margins, and scale-based efficiencies will drive long-term value growth. Anyway, the valuation is a 20. They traded only 20 times net income That is inexpensive for how growthy they are. So here's a very important metric. They're monthly active consumers. So not just monthly active users, but monthly active consumers went from 170 million last year to 199 million this quarter. So obviously half the revenue is mobility, ride sharing. Then they have this delivery business. It's 40% of the revenue. Check out the growth rate of their Uber Eats, and now they're doing business to business delivery. The growth rate's growing. The delivery revenue grew 34% year over year. That's actually the fastest it's grown in years, the fastest growth rate on the whole screen. So that's great for Uber. And if we just zoom out to the profit, like they're basically net income right here, they're the most profitable they've ever been. Like in 2022, it was a tough buy. Who was buying the stock? They were losing like 500 mil a quarter. Well, now Uber's making close to like 1.5 billion of net income a quarter. And at this growth rate, what's it going to be the same time next year? You don't get a dividend with this one, but at a 20 forward PE and all the acquisitions that they're doing, they own a stake in so many companies. I'm very okay with them not paying a dividend. So yeah, they are acquiring Spot Hero. Oh no, they already bought Spot Hero, which is a parking spot app that I use. They also are acquiring Delivery Hero. They just do so many acquisitions, like Black Lane, a high end anyway, that's Uber right there. I do own shares of that one, so I might be bias on that one. 37. What's up, Brian Paul? Shout out to member. 37 positions. That's similar to me, although a quarter of mine are ETFs. Hey, yeah. One critique is I definitely own way too many stocks between all my portfolios, but I basically like to make my own S&P 500. I'm the S&P 500. I'm literally the S&P 500, but without the airlines, the commodity stocks, the cruise lines that always underperform. There's some ETFs out there that they literally buy the S&P, remove the airlines, remove the cruise lines, these super recession-prone stocks. Okay, let's keep going here. What's next? Ooh, AMD stock. I actually have been selling a lot of AMD because they are now, in my opinion, overvalued. I would not. Look at all my sell orders right there. I've been taking a lot of profits on AMD. But yeah, it's kind of hard not to because literally 3 months ago, this was a $180 stock 3 months ago. And now it's more than doubled. It's a $520 stock. So yeah, I did sell out of some. I love AMD though. Their CPU business is now going to grow at a 35% rate till 2030. I mean, they just have great revenue forecast. AMD announces Gen 2 memory and package. Maybe they're getting into the memory shortage. So there's recently a memory shortage. They are part of the CPU shortage. A couple years ago, you used to need one CPU for every 8 GPUs in a data center. Now it's a 2-to-1 ratio. For every 2 GPUs, you need one CPU. So yeah, even Morningstar says they're overvalued. Although exceptional demand for server CPUs driven by agentic AI and strategic partnerships for its GPUs will foster robust long-term growth, the stock's current premium reflects overly optimistic market expectations. So yeah, the risk reward doesn't look great today. At an $850 billion market cap, for you to double your money, they have to be worth $1.6 trillion. Just from a law of large numbers, it's definitely a tougher double than some of the other stocks I see out there. And at an 80 forward PE or 80 times next year's net income, I agree that it looks overvalued. The revenue forecast and net income forecast are great, but at current price, I don't like it. And that's actually why I've been trimming out of AMD, but I'm definitely not fully selling. I'm actually probably going to keep these 6 rest of my shares forever. I've more than got my money back on AMD, so I'm just going to hold on to my shares forever at this point. All right. How about the VOO ETF? Yeah, this is just the S&P 500. Most retail investors, hedge funds, institutions literally cannot beat the S&P 500. So if you can't beat it, please own it, even if it's a small position. So when it outperforms you, not if it outperforms you, but when it outperforms you, you won't feel left out, and it will outperform you. Especially in certain environments. But anyway, this is a great market cap weighted ETF right there. You can't go wrong. If you just buy the S&P 500, no financial advisor would call you crazy. That is historically the best way to beat inflation. The S&P 500 just gives 8% of your money back a year. Okay, let's see what's next here. What's up? Hey, what's up, Kudos? Can you do USDE? What is that? Let's see. Stablecoin X. Whoa. Okay, this see, we probably won't cover this one. We don't really cover these micro caps. Yeah, if you look at the top right, they're only worth $80 million. And look at this volume. Look at these candles. There's no volume on the stock. But let's just do a quick glance at the fundamentals and see if we can find out why they're only worth $80 million. They don't even report. So they just IPO'd. We only get 2 quarters of data here. That's like a 6. They did. That's kind of scary. They did $666 of revenue this quarter. And it's a scary number too. Maybe we can go to their website, but like, If you really like the stablecoin market, I would get Circle. They own USDC and have a 28% stablecoin market share. Is a Circle, CRCL, that owns USDC. I just be careful with that small market cap, and there's nothing for me to analyze. So I see Credo. Luckily, I know that ticker symbol. Hey, for people asking for stocks, please give me just the ticker symbol. Like, people are saying some weird names of companies I've never heard of before. If you just give me the ticker symbol, that would be a lot more ideal. So anyway, here's Credo Technologies. If you've never heard of this stock, this is a pure AI infrastructure beneficiary right here, and the stock's at all-time highs for a reason. They deserve to be at all-time highs. If we just, glance at their financials, it starts to make sense. Revenue grew, the lifeblood of the company, the revenue grew 157% year over year. Look at all the year over year growth rates. It's grown to over triple digits for 6 quarters in a row. Look at that. 250% growth after 170, but not just revenue growing, but actual net income. They're the most profitable they've ever been. This was their highest ever net income quarter. If you notice, the revenue grew 150, net income grew by 360. The net income grew faster, which means margin expansion. Net margin went from 21 to 38. So for every $100 that comes in, they keep $38 after tax. That's ridiculous. It reminds me of Palantir. Plus, what takes a lot of risk off the table is they have no debt. Literally no debt, 1.44 billion of cash. So every time they make, 160 million net income and how much free cash flow, 177 million free cash flow, that just goes straight to their cash pile because they don't owe anyone any money. Absolutely great company, but the valuation does worry me at a 45 forward PE. Now is not the best time to enter this one, but I would definitely put it on the watch list in case they have a dip. US is 60% of the sales, then they have some China exposure, 30%, so be careful of that. But anyway, these net income forecasts are great. They're still over 100% EPS growth they're experiencing. So you really want to do like a PEG ratio, multiple year out, forward multiple. Hey man, I'm new. Do you have any tips that can actually make me fully use it? Yeah, hey, unknown. I have some videos on my YouTube where I like fully show you how to use the stock or this app I'm on. There was a stock I wanted. Yeah, hey, try not to spam there. Oh gosh, I'm missing the stock I wanted to look at. Hey, sorry if I'm missing some of these stocks here. We got so many people on the stream today. What's up, Hot and that one and Emperor Penguin? What's up, everyone? So what is BLSH? Yeah, and then we'll try and get to Near and some of these other ones. So BLSH, stock is just called bullish. All right, they're at an all-time low right now. Let's see what they do. Providing infrastructure and information services. Well, that doesn't look good because if we go to the lifeblood of the company, the revenue declined 35% year over year. Last quarter fell 2.5%, 23%. So maybe that's why they're at an all-time low. The lifeblood of the company, the revenue is deteriorating. They're headquartered in the Cayman Islands, so I'm assuming they don't pay any taxes. Headquartered in Georgetown, Cayman Islands. So bullish to acquire Inquini for $4.2 billion. Huh. Start trading with $0 fees. Maybe this is like some international brokerage. I don't know. Capital markets, software. I would just be cautious with this one simply because of where they're headquartered. And the fundamentals look like the revenue looks like it was declining. So, all right, what's up? Gary said Robinhood stock. Let's do Robinhood right here. So this is a brokerage. I have the Robinhood app right here. So I'm a customer. I probably give them a lot of fees and stuff. Anyway, Robinhood's doing really good right now because of prediction markets. So they just disclosed every time you buy and sell a stock on a brokerage, they only keep a 0.1% fee. Whenever you do a prediction market, they keep a 2% fee, literally 20x more valuable for their bottom line. So that's why they're pushing prediction markets so hard. And that's why every financial app is getting into prediction markets because they're so dang profitable. They're copying Robinhood's success. So anyway, check this out. Here's their actual volumes. Yeah, one reason the stock is down is because of crypto. Well, it's not down anymore. It's had a nice recovery. And I predicted Robinhood's going to recover faster than Bitcoin will because Robinhood stock used to follow Bitcoin because they made so much money off the crypto revenues. But their crypto trading volumes, look at it from last year. It's down 40, 50%. And if we just look at the actual price of Bitcoin, it's down 50% from 1 year ago. So it starts to make sense. But these event contracts are up to a record 3.9 billion of these prediction market events. Anyway, I love brokerages. They're money printers. I own so many brokerages like Moomoo and Robinhood and SoFi. So if we go to their net margin, they legit just keep 30 to 40% net margins every quarter, pretty much collecting royalties. Every time you buy and sell a stock or crypto or a prediction market, you just collect a high margin fee, 40% margins. making a couple hundred million in net income every quarter. I am up like 700% on this stock. So buying it today, well, they're at a 53 forward PE. So it's the risk reward of buying today definitely does not look good. But this is still a quality company that you'd want to put on your watch list in case it does fall like a good significant chunk, maybe back down to this $80 level. That's where I would feel more comfortable buying more shares. But yeah, Morningstar says they're a bit overvalued right now. Exposure to volatile cryptocurrency trading, Lumen regulatory scrutiny on prediction markets are some risk about Robinhood. But yeah, actually, that's one of my biggest regrets is every share I've ever sold a Robinhood. Like, check this out. This is why some of your biggest regrets would be selling great companies. I look at this in the kind of middle here. I had 53 more shares and I sold it at $36 a share. Robinhood's $112 a share today. So RIP all the shares that I sold. All right. Yeah, I'm a fan of the whole brokerage industry. I own that Robinhood fintech app. I own Moomoo, this fintech app right here. Their stock as well. All right. Yeah, hey Matt, we deep dive the first time you asked that, we already deep dive into Visa for you. Yeah, dude, Visa's a great one, Matt. And CEG is great too. Oh gosh, I'm so behind. Let's do TWLO. Oh, dude, remind me to get to SoFi. Yeah, what's up, Motivate? I want to do SoFi and see BMY. Sorry if I'm missing stocks. I appreciate everyone that's saying stocks. We just have so many people on the stream today. I appreciate everyone. If you're enjoying, please leave a like. Oh yeah, I literally sell nothing. I'm just doing this for fun. I have no course book. I literally nothing. The only way to support me is just leave a like. So here's Twilio. This is a software company. I remember Kathy Wood was pumping this stock a bunch. Is there any news? Well, anyway, they had a little nice gap up ever since their earnings right here. Let's go see what their earnings report was. So the orange line's what analysts projected. Yeah, they beat on revenue, they beat on net income, they beat on EPS and on EBIT. So it was a quadruple beat. So no wonder they're up so much after earnings because they genuinely beat by a big chunk on earnings versus what the analysts projected. So yeah, if we zoom out, excluding that one-time adjustment, they are the most profitable they have ever been in history. You know, like 2 years ago, they were still losing 50, 100 million a quarter. Then now, just 1 year later, now they are literally the most profitable they've ever been. Made 107 mil this quarter. Yeah, analysts project 72 mil, 84 million. So what's a forward multiple? So it's an 86. So that still looks very expensive, 86 times next year's net income. But that's basically because they're just now getting net income positive for the first time ever, I suspect. But anyway, they kind of deserve to have a high multiple because yeah, wow, look at that revenue growth over time. Yeah, the record revenue this quarter, record profitability as well. But it might just be part of the stocks. Maybe they're down so much still from 2022. Maybe we're in the basket of stocks like Adobe, Salesforce, where maybe they'll get hurt by AI. But I don't know. I'll do a quick glance at their website. The platform for converging in the AI area. So the infrastructure behind every magical customer moment. Intelligent self-service, okay, yeah, cookies. Okay. You know what? Anyway, Twilio communications, messaging and voice. Anyway, that could be something to look into. The forward PE does look a little one. Oh yeah, here, let's do what is this? Someone said near. Okay. This is iShares short duration bond active ETF. So basically bonds are just IOU debt. So yeah, you kind of buy this for the dividend. You get a 4.43% dividend yield. So yeah, there you go. All right, next up here, what app is the one you use? Yeah, this is my favorite. If you're looking to buy and sell stocks, this is my favorite brokerage to buy and sell stocks on. If you'd like to get it, you can just type into Google Moomoo. But if you use my affiliate link, I actually have it linked in like my profile, like bio there, if you want to check it out. Okay. Oh, near is a crypto. Oh, yeah, hey, we're not really looking at crypto on here. Because simply there's nothing to analyze on crypto, but that's kind of a cool feature. Bitcoin, they can't miss on net income. There is no net margin. They report quarterly. They can't miss on any metrics. So it's kind of like a cool catalyst-free asset. Bitcoin requires over 1 trillion fresh capital for next parabolic rally. Okay, well, anyway, crypto is down bad this past year. It's actually underperformed every traditional asset the past 5 years, gold, silver, S&P bonds. It's unfortunate because I was just looking at the statistic, almost for the past 5 years, almost every investor is underwater on Bitcoin. It's unfortunate. Out of church, straight into my favorite live stream. Hey, what's up, Plasma? Hey, I got church in 2 hours. What's up, man? Okay, what's up, David? He says DRTS stock. And again, sorry if I'm missing some stocks. Okay. I see Eaton. Remind me to get to Eaton and SoFi and boom. I want to get to all these. So here's Alpha Tau Medical. I'm not sure what this company does, but they're at a crazy multi-year high right now. So for them to have such a good rally, there must be some fundamental reason. Oh, so look at this. If we go to right now revenue, it says no data. So this company has never sold anything ever, but I assume they're rallying because there's now forecast. It looks like the next 2 quarters. So they're basically, you're buying this company as they're making their first ever sort of revenue ever. Next quarter, they're supposed to make their first ever sort of revenue, according to the few analysts. So that is still such a tough situation. They're also headquartered in Israel, Jerusalem. So that's another, where they're headquartered is definitely a risk as well. So anyway, but if their technology works, that could be something very interesting. I guess here's maybe what they treat or something. Interesting. But again, you're paying for a lot of future risk, especially after this rally that they've had, and they have no revenue yet. So you're basically buying them as they're converting from a revenue list company to having real revenue. So Eaton, this is a very cool electrical infrastructure play, pretty much helping data centers build the complex electrical work for the data centers. They also have an aerospace business, which is pretty cool, but they've had a pretty monster rally these past couple years from data center tailwinds. It's also a great dividend growth company. So if you buy the stock, even after this huge rally right now, you're still getting over 1% of your money back a year, just in a qualified dividend, and they raise their dividend every year faster than inflation. They're at a 31 forward PE, which is a little too, actually, that's probably fair. It's not undervalued, but it's not overvalued. It's like a fairly priced right now at a 31 forward PE. So yeah, Electrical Americas. Oh yeah, here's their aerospace business right here. It's 15% of all their revenue. It's growing nice double digits. It grew 16% this quarter. That's actually the fastest growth rate on the entire screen. So the growth rate's like growing. It's picking up on their aerospace business, and they're very net income profitable. Check this out. If we zoom out, they're easily making $1 billion, or they had a slight one-time adjustment this quarter. They're making $1 billion of net income every single quarter. And if we look at the analyst forecast, here's what's interesting. In 2 quarters, the net income is supposed to hit 1.23 billion. So there's still a lot of EPS growth and net income growth for this company still to come. They're still going to hit record net income in a couple quarters, and I suspect they might even beat on these metrics. Oh, look at how the revenue is going to bump up too. They might even beat on these metrics because of the data center tailwind. I guess there's no news around Eaton right now, but pretty cool electrical infrastructure play. What stocks would you recommend buying this week? Well, of course, none of this is financial advice. I don't really recommend anything, but you would love to watch the beginning of the stream. Basically, some of like Meta, I think, is a steal of a deal. Microsoft, Uber. Let's see what else. Here's actually all my most recent purchases in their exact order. So, like my most recent purchase is Rollins, and then Moeller Industries, Netflix as well. Netflix is another interesting one. All right, next up here. Hello, what about FCX? Is that Freeport? This is your pure copper commodity play. So if you're bullish on the commodity of copper, this is honestly my favorite stock to buy as just a pure copper commodity beneficiary. Looks like there's a technical analysis saying there's a double top, but that wouldn't scare me out of FCX. The main metric you would just want to look at is net income right here. And as we can see, even during like the depths of 2022, there's even on a bad quarter, their worst quarter, they still made 560 million of net income. So it's good to see that. Well, I guess back here was a little more choppy, but it's good to see that for the past couple of years, they're never losing money. They're always running at a profit. You get a 1% dividend yield as well, and the valuation is only at 22.4. But anyway, I do like this one as a pure copper commodity play, but maybe now's not the best time to buy into them. KNSA, you called it. Is that Kingsell Capital? Oh no, this is Kinksa Pharmaceutical International. Wow. Hey, they're on my watch list. Yeah, congrats if you've ever bought this stock. You're definitely up on your money because they're at an all-time high right now. So, yeah, wow. These forecasts look good. Revenue's going to go from 180 to 240. Net income's going to hit 26 mil. Yeah, net income has never been 26 million before. They're actually the most profitable they've ever been. Yeah, they're consistently making a lot of net income. Oh yeah, I made a video a long time ago, like stocks that could actually have some good returns. Anyway, interesting one here. The forward PE probably looks expensive. Yeah, 47 forward PE. So it might be, don't buy it at all-time highs. But I might have to go deep dive into this company again. They're headquartered in Greater London, the UK. So, Anyway, some pharmaceutical company with great growing fundamentals. So, Nathan, do you look at long-term stuff when you decide to buy or sell? Like you sold AMD a few days ago, so have a PG less than one. Yeah, well, basically the thing with the risk to reward just looked good, and I wanted money, so I do look at that, but I felt the time was right to finally trim some AMD, just for my personal situation. All right, next up. Oh, Plasma said RELY. What is that one? So Remlity, since you like Uber, what are your thoughts on Grab? Yeah, dude, the literal largest shareholder of Grab is Uber. So if you own Uber, you basically own a bunch of Grab. They're the largest beneficiary. So maybe we'll check them out. That's international Uber. Is this pre-recorded? Yes. What's up, Dave? Oh, thanks again for the gifts there, David and Mohit. Thanks for those roses. Sorry, I never said that. So anyway, I'm reading both chats, YouTube and TikTok. So here's Remlity Global. They're a $5 billion company. Let's check them out. So wow, they're actually growing very fast. So if we zoom out, revenue's at a literal record this quarter. It's like the revenue hits a new record every quarter. So revenue's up 25, and look at the net income. They're the most profitable they've ever been. This is when I love buying a company, when they're experiencing these like triple digit net income growth rates and getting net income positive for the first time ever. And look at that margin. They now have a 10% net margin. Beautiful. That, I can see why they've done so well. They gapped up on earnings right here by a huge chunk because I think the market finally realized, yeah, they beat huge on earnings. Look at that net income. Analysts projected 25 mil. That's the orange line. They actually reported 49 million. And that was a real beat too, even on EBIT, earnings before interest taxes. So it wasn't some accounting fluke. They expected 32. They did 53. So it really was a huge beat on earnings. What do they do exactly? So they're a software infrastructure company built for lives across borders, send money online for personal and business. So maybe it's like send money internationally. So maybe it's a way you can like convert currency or something like that. And it's transparent with the fees, like a $2 fee. Anyway, interesting. Maybe international fintech conversion currency app, something like that. Meta is cooked. Meta, honestly, I believe is actually a good time to potentially look into them. IWDA stock. I actually looked up IWDA. What's up, Emperor Penguin? I could not find that one. I did look though. This is the smoothest analysis I've heard. Hey, I appreciate that. Okay. What should we look at next year? Oh gosh, I had like a list of stocks, but then I just completely forgot it. So I apologize if I missed out. Any humanoid robotics shares you can walk us through? Honestly, the best robotics play. Well, first off, this Moog is a huge human robotics beneficiary. Actually, we have like a picture of this, like the robotics. Nope, that's the Space 60 list. Yeah, no, they build the actuators for human robotics. Let's find the issue. Oh yeah, right here. Basically, if you're looking for exposure to like the robotics industry, I mean, Moog does the complete actuators. They own all the patents and stuff. They're great. They're the same ones used in satellites and stuff. Because the biggest like issue right now is making these arms move functionally and not get overheated. But my favorite robotics play besides that is actually Symbiotic, but it's not exactly a human robotics play. This is a warehouse robotics play. This stock is on a dip as well. If you're going to buy any robotics stock, I'd pick Amazon and Symbiotic. I wouldn't buy Rich Tech Robotics. I wouldn't buy Serve Robotics. I would get Symbiotic. This is another one that owns over 1,500 patents and trade secrets. Here's like an actual video of their robots going. And their largest customers, literally Walmart, Albertsons, these huge grocery stores. Here's their selling point, 60 to 80% labor warehouse cost reduction. 15% increased shipping speed. Very, very good metrics here. And here's the Walmart CEO. I'm about to talk about Walmart because Walmart's actually the very largest shareholder of this company. Walmart loves them. So yeah, basically here's the CEO of Walmart. He's like, using the high-speed robotics, intelligent software to optimize inventory helps us to get products to customers quickly and seamlessly. So yeah, they really do have the best like warehouse robotics portfolio. Here's the shareholders right here. Oh yeah, Walmart, they love them so much. Walmart owns 11.8% of all the shares. So they're almost like backed by Walmart, where Walmart wants to see them succeed. And check out the revenue growth. It's not some startup with no revenue. No, this company has real growth, real revenue. The revenue grew 23% to 670 million. And you're basically buying them after getting net income positive for the first time ever. So they're basically, just now getting net income positive, getting more consistent, like 13 mil, 9 mil. So the forward PE is going to still look expensive, but look at these future forecasts. They're literally supposed to stay net income positive for the rest of the time. They're supposed to make 14 mil next quarter, 17 mil the quarter after. Look at the revenue growth. Revenue is supposed to go from 618 to 770. So again, that's a cool one you could put on your watch list. And there's a ton of robotic stocks on a dip. You can go to Rich Tech Robotics. Like if you're going to buy a robotic stock on a dip, buy the best one. Don't buy this junk. Rich Tech Robotics. I'm glad no one mentions this too much anymore. Because that one, dude, that would get asked like 10 times a minute. Okay, RELY, that stock we looked at, that currency conversion company, is how immigrants send money to their families. That is their moat. No one wants sketchy international transfer. Oh, interesting. So yeah, that was more commentary on this currency conversion stock, RELY. All right, let's see. IWDA is a London stock ETF. Oh, my bad there. Yeah, I tried to look for it. Fortunately, I couldn't find them one. But if you have another stock you want to look at, let me know there, Emperor. So, you know what? Oh, Marvell. Let's do Marvell. This is your custom chip company. I see. Oh, SoFi next, and then we'll do Celsius and Vistra. Thanks for everyone that's on. We're going to be live for well over another hour, probably hour and 20 minutes left. I appreciate everyone that's here today. Happy Sunday. Hope you had a good 4th of July too. So here's Marvell Technology. NVIDIA gave this one a shout out. NVIDIA CEO saying this is going to be the next $1 trillion company. NVIDIA even took a stake into this company. So Marvell linked to Amazon potential third-party sale of TPUs. Interesting there. UBS raises Marvell price target, projects CXL market to reach 7 to 10 billion by 2030. Wait, what does that say? Cyclical industry could exceed 3.5 trillion. Anyway, so Fitzgerald raised his price target, cites AI infrastructure build out as generational superconductor cycle. Well, anyway, let's go look at their fundamentals. Or what does Morningstar say? So they're fairly valued. Okay, Morningstar says they're fairly valued. Robust momentum in its data center portfolio, driven by explosive growth in its custom AI compute and optical connectivity, will serve as the primary engine for long-term value creation here. And just check out the growth of the future net income. If you look on the left at 750, it's supposed to grow to 1.14 billion. So we really want to look at EBIT because they had a one-time adjustment to their net income. Like back here, it says they made 1.9 billion in net income. They actually sold off one of their lower margin businesses for 2.4 billion. So they had an unrealized gain. It kind of propped up their net income. That's why you look at operating profit, because it excludes all that noise, but it also excludes taxes. So you still want to subtract another 15% from this. But that being said, EBIT, earnings before interest taxes, is going to grow a big chunk, like 30-40% year over year. But when we look at a forward PE of a 99.9, it still makes it look like a tough sell. The risk reward doesn't look great today. But yeah, their custom chip business is great. Let's see. Marvell's strong position in optical chips and custom chip business offer a strong foothold in generative AI infrastructure. Marvell's strong GAAP profitability reflects Modi pricing power. We believe Marvell's wide portfolio of switches, processors, and optical chips gives ample opportunity for cross-selling and market share gains. Here's kind of what the bears are saying, though. Marvell's highly concentrated in data centers, which makes it highly sensitive to in the rate of data center and AI spending. Deceleration could hurt the stock, obviously. Anyway, I don't want to spend too much time on one stock, but I would be careful at the current valuation. Here's a stock, though, that's super growthy, and I'm not worried about the current valuation. I actually just bought some more at $15 a share. So it was like a couple weeks ago. I bought a little at $15.90 a share. But here's SoFi Technologies, a great fintech app. Oh yeah, gosh, I'm so behind. I apologize to everyone whose stock I can't get to, but I'm trying to get to all of them. I will only look at like one stock per person. So here's SoFi Technology right here. They trade literally so cheap, in my opinion, for the growth that they have. The market's giving this one a 25 forward PE or 25 times next year's net income. That is undervalued for the growth rate of SoFi. We go to their main lending business right here, which is 58% of the revenue. It grew extremely fast, the fastest on the whole screen. It grew 55% year over year to a new record. It's never even been close to 640 million before. So that business is at a crazy record, growing 50% year over year. Then we have the financial services business. Check out the growth rate year over year on this one. It's up 41% year over year. After it grew 101, after it grew 85, after it grew 195, after it grew 290. They are on an insane streak of growth. Okay. So yeah, SoFi, that's what's very interesting about this one. And if we go to net income forecast, look in 2 quarters. Analysts are projecting 240 million of net income in 2 quarters. The net income's never been close to that before. Oh, well, this is, let me go to quarterly. The net income is still going to have massive growth. Like last quarter was 170, a record. It's still going to grow to 237 million. EPS is going to grow to 17 cents. EPS hasn't ever been at 17 cents before. So there's still a lot of growth on SoFi still to come. That's why I think a 25 forward PE is cheap. And check out the revenue growth, like the lifeblood of the company, the revenue, the sales grew 42% year over year to 1.1 billion, a new record. JP Morgan has a stake in this company as well. But anyway, it's a cool little, they have their own banking charter. They got it through a loophole that's patched because of them. They just have a great growth metrics, and at a 20, like they look expensive right now at 40 times PE, but it's a growth company. You want to value them on a forward PE or next year's EPS. And when you do that, they're only at a 25. So SoFi isn't one you probably want as a huge size position, but maybe still as a position. So I regret all the shares I've ever sold at this one, but yeah, we only have 25 shares of SoFi left. I've been holding this stock for years. Like literally, like here's my first ever buy order down here in January 2023, and I've just been holding on ever since. All right, so Celsius, yeah, I wanted to get to Celsius, and then oh yeah, what's up? Oh yeah, if you're on TikTok, TikTok just removed my For You page eligibility, so RIP. The viewers should like spiral to zero from here. But anyway, if you want to support me, there's only one way to support me, and that's just to subscribe to my YouTube channel. Please just watch from YouTube. If you just type into YouTube Nathan Robert, you'll find my stream. That's the best way to help a brother out. I sell nothing, just on here, give my opinion. Best way to support me, just pull up the stream on YouTube, Nathan Robert, you'll find it. So here's Celsius Holdings right here. This is your energy drink play. They have like a 30% market share in the US for energy drinks. So they now own Alani. So they don't just own Celsius, they also own Alani, and they own Rockstar Beverage now. So yeah, we've all probably seen these like new popular drinks and stuff. You know, Monster beverages are huge. That's their like one big competition. But that aside, like this is a pretty good deal of a stock. They're at a 19 forward PE, or only trading at 19 times net income. It says they trade at 77 times net income right now. That's wrong. They had a one-time adjustment ever since they moved their distribution over to Pepsi. So they had a total one-time gap adjustment. Like it says they lost 60 mil that quarter. They actually made 160 mil. They just had a one-time termination fee, which hurt their gap metric. But anyway, if we look at future forecasts, they're supposed to make 108 mil in net income next quarter, 112 million the quarter after, and that's how we should really value them off of, excluding the one-time adjustment. They only trade at 19 times PE. Seems very fair. Morningstar says they're undervalued. You know, strategic PepsiCo distribution partnership and its demographic diversification via the Alani acquisition will drive long-term value growth despite a highly competitive environment. So I agree with them. I love Alani's. I see them all over my college. They bought them about a year ago, and they own 8.8% of the company. And they're backed by Pepsi now, so that's another big win. So what is Boom stock? BOOM. All right, let's check this one out here. Yikes. So they're at an all-time low, and they're only worth 120 million. So you just want to be super careful with these micro caps. They're only worth 120 million. It's just too tiny to trust. You know what I mean? So what was the revenue? So yeah, if we look at the revenue, the lifeblood of the company, the sales, I can start to see why the stock is on such a decline, because the fundamentals are declining. The lifeblood of the company is down, you know, the revenue's down 14.8% after it fell 5% year over year. So they're just on a nasty downtrend of the business. And to the point where you look, they're now losing net income every quarter as well. 6 mil, 11 mil, and 11 million might not seem like a lot, but when your whole company is worth 120 million, 11.8 million is almost exactly 10% of your entire company. So this quarter, they lost 10% of the entire market cap just in one quarter. So it starts to make sense why this stock is at an all-time low. And let's see what the short float is. Or 8% of all the shares are being shorted. I can understand why now. I'd be super, super careful with that one. Meta for the first time starting to sell compute. Yeah, basically, if that's smart in them. If they have excess capacity, just like Google. Basically, that was like YouTube. YouTube is just a big cloud. They have all these servers. They very long time ago, in Stadia, it ended up becoming the Google Cloud, but built out these huge servers for their own YouTube network. And if they have excess capacity, they'll rent it out via cloud business. AWS does the same thing. So how about UPro? What is UPro? I see Dio. What apps are you swapping between? Hey, these are all brokerages. These are all apps where you buy and sell stocks on. They all ask for a bunch of information, send you tax forms. If you'd like to get a brokerage, my favorite one, there's Robinhood, Webull, Moomoo. You can type it into App Store or Google. This is my favorite one right here, Moomoo. If you want to use my affiliate link, I actually have it linked in bio profile. This is my favorite app. It's completely free, costs nothing. It's my favorite app to buy and analyze stocks on. Like on Robinhood, you can just like buy stocks in there. It's a simple platform. You can't really do in-depth analysis and see the financials. That's why I love Moomoo, and you get the cool news and stuff. There's so many cool features I haven't even shown. So anyway, if you want my favorite brokerage, if you want to use my affiliate link, linked in profile bio, it's completely free. If you end up depositing $100, we'll both get like a free stock. Anyway, yeah, link in bio. Here's ProShares S&P 500 ETF. I think this is a leveraged ETF, or what does it own? Huh, that's weird. Like money market, basically cash is 25% of the ETF. Then it's Nvidia, Apple, Treasury bills, Microsoft. I don't know what this company does. They have a 0.9% expense ratio. This investment seeks daily investments. Oh, so this is reset daily. Yeah, you definitely. Oh, it's a 3x ETF. Yeah, you want to be careful with the reset daily ETF. So that's a ETF you probably want to trade, not just, buy, never sell. So let's do DEO, DEO. So this is a Diageo or something like that. Yeah, so this one's also on a massive downtrend. That weekly chart looks very bad. Let's see if they're maybe undervalued. Like, there's going to be some bad news, but maybe the bad news is fully priced into the stock. I don't know. Let's go find out. So it looks like the US is only 40% of the revenue. So most of the revenue does come internationally. So the revenue is kind of growing, or like kind of low single digits. Like if we go to 2019, revenue was on average, or 2002, this is a long time ago. 2002, they were doing $4 billion a quarter, sometimes more. And, to this day, they're still doing $4 billion a quarter. That might be why the stock is the same price that it was in the year 2007, because the revenue is the same and they can't escape this market cap level because the fundamentals haven't improved. But luckily, they're still profitable. Are they same with net income? The EPS is the same that it was in 2001. It's the same net income. So that's probably why they can't escape this market cap. It's tough to, honestly, they're not going bankrupt. They still make, even on a bad quarter, like 500 million. Oh, I'm stupid, guys. I just realized these are all old financials. So, yeah, these are all from 2008. So what is this? Winery and distribution? Oh, so it owns a bunch of drinks. Anyway, I wish I didn't just do all that speech. Okay, so we can't see what brands they own unless they sell drinks. Captain Morgan, Crown Royal, J&B Whiskey. I've heard of some of these before. Guinness. Oh, they own Guinness. They're headquartered in London. Okay, so if you want to, and the alcohol industry is doing very bad right now, like really bad. It's not just them. People, like younger people, aren't drinking as much as they used to. Maybe the GLP-1 Ozempic trend, but even like Molson Coors, this is my by far favorite alcohol play ever. If I had to pick one, used to own them. I don't own them anymore. All food stocks have been crushed. I really like TAP as well. Just joined. Can you look at SOXL? Oh yeah, hey, let's check that one out. Oh, what's up, Brian Paul Plasma? And again, sorry if I'm behind on the chat. I appreciate everyone that's here. Hey, how are you? It's been a minute. Hey, what's up, Michelle? Good to see you, dude. Or Mitchell. So Logan says AMAT. Let's do Applied Materials. This is like an international AI beneficiary. So other countries like China, South Korea, Japan, they're all building out, their own AI and semiconductor infrastructure. And that's the beneficiary of this company right here. Because if you go to the revenue, not much of it's from the US. Only 10% of this company's revenue is from the US. Most is China. Then it's Taiwan, which owns Taiwan Semiconductor, or that's where that's headquartered. They own Korea's the other biggest country. So it's an international play, but I can see why the stock has done so well. They're at this all-time high level, certainly for a deserved reason. It's not just at all-time high for momentum. They are truly beating on the fundamentals. And we've converted the currency to USD. They expected 2.15 bill in net income. They did 2.8 bill. They've beat on net income for the past 3 quarters in a row by a big chunk. So no wonder this stock, every time they report earnings, is just up after earnings because the earnings are so good. They crush expectations. But buying this company today at a 40 forward PE is certainly risky. Like, I'd almost rather buy Nvidia at current valuations. Morningstar says they're fairly valued. The company has a leading position market share across broad wafer fabrication equipment portfolio, positions itself well to capture immense AI-driven chip demand. These long-term growth prospects are largely priced into the current valuation, though. So that might be something you want to be cautious of, but a great AI beneficiary play right there. And the next time maybe that sector is on a massive dip, you could add that one to the watch list if you like more international. Oh, what's up, Burner Mail? Hey, thanks for heading over to the YouTube stream. I appreciate you, man. So, yeah, TikTok just took down my stream, so TikTok viewers are going to stream to zero. I'm basically only going to be reading the YouTube chat from now on because there's I have such a backlog. So I apologize if you're on TikTok. I'm not really reading the chat anymore. If you want to support me though, and you want your stock analyzed, please just type it into the YouTube stream. I'll definitely check it out for you. That's the best way to support me. I sell nothing. TikTok gives me so many issues with my streaming, and they took down my stream for unoriginality and reproduced content. And I go to appeal it. TikTok doesn't appeal it for hours, so I can't do crap. TikTok literally every other platform, Twitch, YouTube, you can say stuff like, "Hey, well, you know what? I'm not even going to get into that." Here's Bristol Myers Squibb. This is a cool healthcare dividend growth stock. Looks like they have a 4.3% dividend yield, a bit of a high payout ratio, though, with 72% payout ratio, but you get 4% of your money back in a dividend every year. I noticed if we zoom out to lifetime, technically, this stock is the same price that it was in 1998, just like Pfizer was. So if you bought the stock in 1998 for $58, it is still $58 a share to this day. I remember they had a huge like $20 billion loss, and that was real. It led the S&P, like the S&P 500 reports like EPS as well. This specific net income loss, because they were in the S&P 500, made the S&P 500's EPS literally dip, like almost go negative that one quarter. But anyway, yeah, they've had they lost a bunch of money that quarter from a lawsuit payout, but it looks like they're consistently making profits now, 1 to 2 billion net income a quarter. Yeah, and that's real as well. What's the revenue growth rate? Is the revenue growing fast? So, kind of low single digit revenue growth, 2%, 1, 2, 0.5, -5. So that growth doesn't beat inflation. So that's something you want to be aware. That might be why the stock is done so bad. They're not really beating inflation, but Morningstar says they're undervalued. Solid double-digit growth from newer therapies like Camzyos and Breyanzi combined with robust late-stage pipeline will drive long-term value growth. So yeah, they basically just sell a bunch of different prescriptions like Eliquis. What is that? That grew 16%. Interesting. Their Opdivo, that one declined 5%. That one's up 6%. Anyway, do we get maybe like a more... Okay. So the growth portfolio surged 12%, led by strong sales of Camzyos and Breyanzi up 56%. Legacy portfolio, though, declined 6% due to generic competition impacting products like Remvlib. Anyway, still would be cautious with that one. If you buy this stock, I don't know if that's going to beat the S&P 500 for the long term. So you may just be better off with the S&P. You know what I mean? Yeah, hey, what's up, Dark Intel? I appreciate you coming over. So, Jeff Mack. Hey, shout out to YouTube member Jeff Mack. Dude, I appreciate you. Hope everyone had a great 4th of July, great Sunday. Here's Texas Roadhouse. This is a very well-managed restaurant right here. They have one of the best management teams. And if we look at any restaurant stock, Wendy's, McDonald's, Chipotle, they are all down like huge from their peak. Texas Roadhouse is honestly pretty close to an all-time high, just a few percent off. This has been literally like the best performing I don't know. Wait. Yeah, I don't know. I just got another takedown on TikTok right here. So yeah, if you're on TikTok, please go to YouTube. Just type into YouTube Nathan Robert. You'll find my stream. TikTok keeps... All right. Anyway, here's Texas Roadhouse right here. You get a nice dividend. If you buy a share even right now, you're getting over 1.5% of your money back just in a qualified dividend every year. Yeah, Texas Roadhouse is most of their revenue. Then they have some other restaurants like Bubba 33's. Anyway, if we just go to net income right here, very consistent net income, and it grows over time as well. It's up great from 2019. They're making a lot, like double the net income as they used to. So yeah, making close to 100 mil in net income a quarter, 1.5% dividend yield. But what's the valuation? Yeah, so actually that's not even super overvalued. A 28 forward PE. It's interesting to see like Texas Roadhouse doing way better than every other restaurant. Wendy's is literally about to go bankrupt. Did you know if you bought Wendy's in the 1997 IPO, you're down over 50%? Wendy's is at an all-time low. Jack in the Box is at an all-time low. Red Robin's at an all-time low. Krispy Kreme's at an all-time low. Cracker Barrel's at an all-time low. Literally, almost all of them are going to go bankrupt. It's almost like sad. There's just too much labor inflation and input cost inflation for these restaurants to even like barely get net income positive. So that's why McDonald's is my favorite position. They don't own the stores. They're not the one running the restaurants. They're all franchises. And all the franchises have to pay a 4 to 5% royalty back to the corporation. So that's why McDonald's is my favorite restaurant pick. Texas Roadhouse is another great one as well. Yeah, I actually have $5,600 in McDonald's. Just bought a little more of them last week. And I'm slightly down on them, 0.9% down on McDonald's. But I own them for a reason. Great dividend growth stock. I bought 200 shares of Micron at $35 a share. Dude, this guy must be like the best investor ever. He bought 200 shares of Micron at 35 a share. Holy smoly. Hey, what's up, General? He says, hey, any backup generator stocks I can look up? Backup generator stocks, United Rentals rents out generators, but maybe like a Generac. Generac right here always benefits whenever there's tsunamis, hurricanes. These generators are bought up like crazy. So, anyway, what's really led to the growth is not the residential business, like people like you and me buying generators. The main growth driver for Generac has actually been huge, like tech clients, rich enterprises buying their generators. So some like data centers right now literally can't get connected to the grid for a couple of years. So they're literally building their own in-house, like on-site power generation. And if we go to their commercial and industrial business, that grew 27% year over year, the fastest growth rate on the entire screen from Generac. No dividend on this company, but yeah, they make those Generac generators. You've probably seen them before. Yeah, decline non-essential cookies. Let's see. Can we get like a picture of it? Yeah, well, they're not that tiny, but they do, I guess, sell tiny ones like that, and for your home as well. Anyway, I'm sure you get the idea here. Maybe that kind of help. I know Anchor maybe. Anchor is a Chinese stock though. You know those Anchor batteries? They always make the most high quality stuff. I wonder if Looney's in here. Looney loves that stock. So Bargain said eBay stock. I heard GameStop is trying to buy eBay. I don't know how they're going to pull that off. GameStop proposes 125 per share acquisition of eBay. Boards rejects offer. So yeah, you're not buying this as a buyout play. I mean, if you bought it today and they got bought out, you still get like 15-20% of your money back. But I just don't think eBay will ever accept that because they don't want to be merged with them. But honestly, I love eBay. They have really good international shipping tools where they will handle all the international headaches. Like there's these weird, like whenever you ship something internationally, there's like taxes and weird forms you have to pay and new tax forms that you've never received before, when eBay simplifies all that for you. Anyway, they're easily making, like if we just average it out, like 500 million of after-tax net income a quarter. It's actually really good. So I can actually see why this stock has done so well. It's pretty close to an all-time high right now. And it's a nice dividend growth stock. You buy a share today, you're still getting over 1% of your money back in a dividend every year. Morningstar says they're undervalued or overvalued. The company benefits from a solid network effect in enthusiast and re-commerce categories. Elevated market spend requirements and intense e-commerce competition pose significant headwinds and long-term risk. So like, yeah, maybe Amazon, Etsy, those could be a fear. But I mean, eBay's still doing good. Wouldn't buy them at all-time highs though. But I've been impressed with their fundamentals. BMY is going to lose so much money when Eliquis goes generic. Oh, hey, what's up, Brandon? Oh, Ping. What's the PENG? And I apologize if I'm a little behind here. Bro, it's Mike. I'm buying MLI tomorrow. Thank you. Yo, what's up, Mike? Hey, dude, thanks for watch. If you want to watch my most recent video, it's a whole deep dive on Moeller Industries, my newest purchase. I might actually analyze it on stream if anyone wants, but a great copper piping and tubing company. So here's PENG, Penguin Solutions. It's like a cybersecurity software company, if I remember. And check out that rally. 3 months ago it was $18. Now it's a $60 stock. Wow. So, never mind. I am really dumb. It's not a software company. This is a memory stock. So this is basically like a smaller version of Micron, a smaller SanDisk. So they're only worth $3 billion, but yeah, their stock almost looks identical to like the rally that Micron has because they sell memory, optimized LED and advanced computing. So yeah, anyway, this memory business, grew 63% year over year, and I bet there's no stop to how that's going to grow. Yeah, look at the revenue forecast. Revenue is going to grow to $474 million. EBIT's going to hit a record. So that's probably what the stock is pricing in right now, all the future growth that they're about to experience. So basically, whatever Micron does, it probably will it won't move exactly, but it'll rhyme with whatever Micron does. What are your thoughts on, hey, what's up, Confused Typing? He says, what are your thoughts on MKSI stock? Let's check it out. And we'll look at, I Live Cake, Cake Stock, CAKE, the Cheesecake Factory. We can also look at Kava, Chipotle. Yeah, those have all tanked. So here, well, because of the restaurant, we'll get into that in a minute. So here's MKS stock. I have actually not heard of this one before. They're at an all-time high. Well, besides on Friday, they fell 11%, but they're still pretty close to an all-time high. So if you've ever bought this stock, congrats, because you're probably doing really good on your position. Let's go see what they do. So Vacuum Solution Division, Material Solution Vision, and Photonic Solutions. Huh, so it sounds like an AI beneficiary. They're in the scientific and technical industry. Huh. Let's go to their website right here. I assume they're not selling residential vacuum cleaners. I assume this is something specific right here. So precision motion control, laser and LED measurements, ultra fast continuous wave. Huh. Stuff that you probably want to do some more research on because I'm not too sure exactly, but some sort of AI beneficiary. And I can assume that because the stock's at an all-time high. I'm assuming that, photonics and what was this other business? Like it's probably benefiting from AI. And the revenue forecast look good. Revenue's going to go from 980 to 1.24 bill. Net income's going to go from 74 to 151 mil. So the net income is more than doubling year over year. So yeah, let's do a forward PE. So look at that. They currently trade at 76 times net income, but only 39 times next year's net income. It basically gets cut in half because the EPS is growing like 90% this next year. So you really want to do like a PEG ratio. Anyway, I can see why the stock has been so rewarded. Fundamentals are at a record. Yeah, if we zoom out, revenue is pretty much at a record this quarter. And I guess maybe it's a cyclical industry. In 2021, they were making 150 mil a quarter. Now they're still not back to that 150 million a quarter level. But the stock's at an all-time high. Anyway, that's just something to be aware of. So yeah, if we look at Kava is basically a Chipotle competitor. They do the same thing pretty much. So here's Chipotle stock. Look at how down bad they are from the peak. Just like a year ago, Chipotle was $68. Now it's $35 a share. Again, it's not just a Chipotle. We saw Wendy's stock, RIP Wendy's. They're lower than their pandemic and their IPO price. Jack in the Box, Red Robin. Now here's Jack in the Box, lower than their 2001 price. So all these restaurants are being hurt, and Kava is no exception. So honestly, my favorite restaurants to buy, I'd probably rather buy Chipotle because this is like a smaller, nichier Chipotle. But let's go check out the financials right here. So their revenue, oh wow, check that out. Revenue is growing very fast. If we zoom out, this is the highest ever revenue quarter ever. Revenue is 430 mil, up 32% year over year. But the net, okay, so the profits increased by 56%. Actually, technically, this was their most profitable quarter ever as well. I wonder if that's just from opening up new stores. I wonder if we get additional context on that. So restaurant segment saw robust growth with 92 net new openings, 9.7% same store sales increase, driven by higher guest traffic and favorable volume mix. Store expansion continued with 20 net new restaurants added during the quarter, totaling 459 locations across 29 states. So there we go. They got 459 locations. And 30 new locations just this quarter pretty much. So anyway, yeah, like they got these like salad bowls and stuff. Interesting there. So I'm hoping we get a huge rebound in the like restaurant industry. I know there's like beef inflation as well. That's a struggle. Thanks, man. I wanted to see if there's any other potentials that are cheaper. Also, Generac is just fossil fuel based. Yeah. Huh. Yeah, I don't know. Generator stocks. I mean, if you like things that produce energy, how about CEG, Constellation Energy? They own over 30% of all the US's active nuclear reactors, purest play for nuclear energy. And if you like nuclear and want exposure to nuclear, this is the best play and the number one geothermal company in the whole US. Basically, there's like these geysers, or the properties they call these. It's a property called the Geysers in California. Supplies 20% of all of California's clean energy from this one geysers facility. Literally from the earth, it lets out this hot steam from geysers. They capture that into a steam turbine. It's free electricity. Then they pump cool water back into the bottom, and it literally is an infinite energy cycle. Okay, I want to take a tour of that place as well. It's a famous place in California. So let's see what's next. Plasma said LXU. What is LXU? Oh, we'll look at Cake Stock and SOXL. Hey, Nate, where did you get all the money to first start investing? That was actually from my original YouTube channel. I used to run an old YouTube channel. I'll pull it up really quickly just in case for the one person that's curious. But give me just 10 more seconds here. Oh my gosh, my Wi-Fi wants to be terrible. So you know what? Maybe I'll do it later. Oh, there we go. Switch account. Yeah, so basically I have a YouTube channel called Rust Moments. Well, I don't run it, or I don't run it anymore. But anyway, yeah, check this out right here. These are all, I've made thousands of these videos. This was my job for years. I literally, look at these. These are all like 4, 5, 6 years ago. My day, every day, I'd upload every 2 days. And this is where I got most of my money to invest. I made over like 80K on this channel. I want to actually see how much, and then we'll, like this video right here. This video got like 400K views, 90K watch hours, made 1.5K. Anyway, that was my old Rust YouTube channel. But anyway, here is LXU stock, LSB Industries. They're only worth 765 million. So you want to be careful. You know, that's still a really tiny market cap, only 700 million. But the stock is unfortunately the same price as they were back in 2007. So they've kind of been down for a while, but they do ammonium nitrate. So this is a fertilizer play. This is actually probably my one. This is not the best fertilizer play right here. So yeah, they do agricultural products and stuff like that. Fertilizers, ammonia. I actually just bought probably their biggest competitor, and it's my favorite fertilizer commodity play of all time that actually benefits from the Strait of Hormuz. This is the only like fertilizer company that benefits from their production. I'm about to make I might make a video on this one, but anyway, this is CF right here. They only traded a 6.1 forward PE, 1.8% dividend. And the coolest part about CF is like even during the bad years, like even during 2022, the worst quarter they had was still 200 million in net income. It's still, you know, a commodity. Again, if you're going to own a stock that sells a literal commodity, there's a few things you want to look for. A low forward PE like an oil stock. You know, they trade at 6.1 times next year's net income. A good dividend yield, because while you wait for the cycle, you get good dividends. So you get 2% of your money back in a dividend. And I like to see a very net cash position. They actually have more cash than debt. And my favorite metric is the share buybacks. Look at the very bottom left. There's 153 million shares that exist. The same time last year, there was 164. The year before that, there was 184. The year before, there was a 203 million. Look at the share buybacks. This wasn't even that long ago. 2021, there were 207 million shares. Now there's only 153. They buy back like 7% of the stock every year. They could choose to pay a 7% dividend every year, but they're smart. They know they're a commodity stock, so they buy back their own shares to really give long-term value creation. So that's an interesting one. But LXU still might be good because check this out. They're not, the net income is tiny, but look, see, I like CF more because in 2024, they actually lost net income when CF wasn't losing net income, but they are back to making net income. You know, they made 19 mil this quarter, which was real. They really did make 19 million after paying taxes. When your whole company's worth 760 million, that's a good chunk of the company you're making in net income. But actually, the stock looks very similar to CF the past couple months. Cool for a smaller, nichier fertilizer play. So here's the Cheesecake Factory. This one has actually, they're at an all-time high right now. So congrats if you own this one. This one has a bit of a slower growth profile than most of the other restaurants I've seen. But basically, if we go to their main business, the cake stock is the Cheesecake Factory. I go there every year on my birthday. So, cucumber lemonade's the best. But look at this growth rate. It's kind of low single-digit growth rates, you know, 2.6, 1, 0.5, 1, 0, 1, 3, 3, 1, 2. So you know what I mean? Like this low single-digit growth rate that doesn't exactly beat inflation. But that being said, the stock's at an all-time high, so it doesn't really matter. And you get a nice dividend, a 1.4% dividend yield as well. What's the valuation or forward PE? I mean, they trade at, you know, a 19.7 forward PE, not too shabby. So, and they make net income every quarter. The net income is kind of the same. Here's the one part that is a little concerning. Like the net income is kind of the same that it was back there in 2018. But actually, no, it's higher. It's higher. Actually, yeah, it's hard to be bearish. 19 forward PE. Cheesecake Factory, pretty cool. Another one is like ticker symbol EAT. This is Chili's. Oh wow, look, Chili's is doing great as well. Ever since they cut their dividend, Chili's, they had like an Nvidia moment back here. So yeah, this is the one that owns, yeah, Chili's is 92. Oh, what's the other one? They own, you know, what's that called? Gosh, I'm not going to remember it. But they own Longhorn Steakhouse and, okay. Hey, what's up, Mr. Phil? Check out Surf Air Mobility. What's the ticker symbol? Is that SURF? So this stock just got like a stake from someone, but I actually would not buy this stock. I'm actually bearish on this stock right here, and I don't mean to be that. Can you explain the PE in the forward PE? Yeah, hey, basically right here. Yeah, I'd love to explain that. So right now, actually, this is not a good stock to use on an example. I'll just do, what's a good stock? SoFi. Quickly explaining what a PE is, because that's basically a simple metric. It's price to net income. price to earnings or EPS. Currently, they trade at 40 times net income. The trailing 12 months EPS for the last 12 months, they trade at 40 times net income, but the forward PE is valuing them off next year's net income. And for growth stocks, that's really what you want to do. And SoFi only trades at 25 times next year's net income. And basically, it uses these projections. So the orange line in the future, it prices in that. So, and it also, like, if a company's forecasted for the net income to go down, the forward PE also factors that in. So anyway, here's Surf Air Mobility. They're at an all-time low, and I can kind of understand why. I think like Palantir was supporting this company or something, or partnered with this one. But anyway, if you look in the top right, they're only worth the very small company, not one. If you have a lot of money, you work hard for your money. I don't think you want to trust most of your money in a $115 million micro cap at an all-time low, but it could be a fun short-term swing trade or something. You know what I mean? Do they have revenue yet? So they do have revenue, 25 million, but here's the bad news. They lost 20 million this quarter. Just here's how I like to approach stocks. I think about this super basic logically, and you could literally do this. You could buy this whole company for 115 million at this valuation. You could buy into this stock. So let's say you do it. You buy this whole company for 115 million. So we pay it. We pay 115 million. Here's what you're buying. You're buying a company that lost you 20 million just in the first 3 months, then 30 million, then 27 million, then 28 million. So literally in 1 year, you've already lost more than 115 million in net income in literally 1 year. And that reflects in the balance sheet. Look at how leveraged they are. They have a lot more liabilities than they have assets. So this has the DNA of a stock that should be at an all-time low. We can totally understand why this stock is at an all-time low. And that's why I'm having a huff. I definitely would not recommend this one. I mean, it looks like there's some revenue growth, but when the net income, you're supposed to lose 15, 12 mil, and you're only worth 120 mil, that's devastating. Or 115 million, and you lose 15 million, that's devastating. It's 10% of the whole company. So what about gold? Yeah, gold, actually, here's a cool thing. Gold is off a peak up here. This is the literal commodity of gold in an ETF. It's run by BlackRock. It's the exact commodity of gold, but in an ETF. And it's arguably better than buying physical gold, especially in smaller quantities. If you buy smaller quantities of gold, you're paying the spot fee when you buy it and when you go to sell it. And if you own a lot of gold, if you're smart, you pay for a vault. You know, you store it somewhere and pay money to store it. Well, basically, and it's not liquid. You know, physical gold is not liquid. This ETF right here is literal the commodity of gold in an ETF. It's also SIPC insured for 250K. It only has a 0.25% expense ratio, so it's arguably better than buying physical gold. But there's also the one argument that, you know, you buy gold in case the world ends and there's no electricity. And how are you going to withdraw your money when there's no electricity or whatever? But at that point, the world's cooked anyway. I don't know. So Jersey Mike's IPO is right. Hey, actually, this is a really cool thing I wanted to show you guys. The IPOs this year, these are official prediction market odds. So Jersey Mike's now has a 100% chance of IPOing this year. Apparently they have, and they have a better customer service reputation, and they just passed, not even that long ago, passed Chick-fil-A. This is apparently, I've only been there once before. Jersey Mike's is a better reputation than Chick-fil-A in the US. But yeah, there's actually 77% chance of Anthropic IPOing this year, or announcing an IPO. Aura Ring has a 75, Discord 55. Where's Mr. Beast Industries? 12% chance. Stripe, I've never heard of some of these. XAI, 2% chance. SpaceX already has a yes. Cerebras, Medline. Anyway, I thought that was cool, seeing what the prediction market thinks is going to IPO. So Texas said AMBA again. Sorry, I'm a little behind here. I apologize. We're going to do Road. I've not done Road yet, but we're going to do Road. And what's up, Brian? We're going to do CMI as well. Love that MLI pick from the other day. Hey, thanks, Dividend Mike. Yo, you know what? We'll deep dive into MLI in a couple stocks. Actually, if you want to super deep dive into MLI, my most recent purchase, my most recent YouTube video is an entire deep dive just on that stock. I don't make too many videos where I just dedicate a whole video to one stock, but I believe it was worth it for Moeller Industries. I'll actually cover that one in a couple stocks. So here is Ambrella stock. They've been flat since 2020. So the stock's been flat for 6 years. Let's see what they do. The firm positions Ambrella as physical AI pure play, with AI vision processors delivering 50 to 500 tops. Surveillance, so for surveillance, robotics, and industrial automation and drones. Ambrella secured $800 million long-term agreement with Hanwha for spending 10 years. Okay, so camera revenue. They said something about camera revenue. Let's check out their website right here. Maybe it's some artificial intelligence camera detection software. I don't know. What is this? Our intelligent video devices use face detection, analytics, and multi-object classifications to enhance security, business, and homes without the need for the cloud. Interesting there. So maybe our solutions make cameras smarter by extracting valuable data. So have you ever seen like in China where there's like boxes over everyone's faces and can like detect just by a quick camera view who you are and all your information? Maybe they're helping out that. I don't know. Well, let's see. So they're not profitable yet. That's one unfortunate part. If we zoom out on net income, they've never made net income ever. But if we look, they've actually been narrowing their losses. They lost 25% less money after they lost 35% less. So maybe in a couple of years, they'll be net income positive. Revenue looks a little cyclical, like it's up and then down, not consistently growing. So I can honestly start to understand a little bit why this stock is the same price that it was in 2020. So maybe it's a commoditized industry, camera surveillance that detects faces. That's probably not exactly what they do. I don't know, but maybe something to look more into. But they're not net income positive yet. So doing the way we normally value a company is, forward PE. They have no forward PE. I bet they make free cash flow. Well, it's choppy even on the free cash flow. I can see why they're stuck at this level. So let's do, VST. Yeah, Vistra Energy. That's the second best nuclear play right behind Constellation Energy. Is there any news around that one? Okay. So let's do CMI, and then we'll get to MLI and Road as well. We'll get to all these. Yeah, hey, Taco, I forgot. I'm not even looking at the TikTok stream anymore. Hey, if you want to support me, TikTok took down my stream, so there's like no new viewers can join or find the TikTok stream. If you want to help me out, please watch the stream from YouTube. That's the best way to help a brother out if you wanted to. Just type into YouTube Nathan Robert, you'll find the stream. I sell nothing, literally nothing. I have no course, book. I don't coach. I literally sell nothing. Just on here giving my opinion. So, of course, nothing's financial advice. So here's Cummins right here. This is a car like they do so many things like engines, or let me just check. So distribution, engine, components, power systems. How's that growing? So their power systems, it grew 18%, after grew 18, after grew 3. So very nice double-digit growth there. Components business. So the components one is struggling a little bit. That's down 5 after it fell 20. Engines down 3. So when we combine all the businesses together, okay, the revenue only grew 2.7%. So that's interesting. But I bet most of this rally is led by the power generation business. Let's see if AI has any coverage on that. I do wonder. No, they don't. Okay. So honestly, a 22 forward PE, even that's a cheap valuation. Even though the stock is at an all-time high, honestly, if the growth comes back, this 22 forward PE, that's not peak bubble valuation. That could easily go up to like a 25, 26, 28 before it fully maxes out. But honestly, when your company's only growing the revenue 2.7%, it's hard to justify a higher multiple because the revenue's growing so slow. It was even negative last year. So yeah, kind of, the revenue's been flat for a few years. Net income is still really good though. They're easily making like 600 plus million of after-tax net income a quarter and a nice 1.2% dividend yield. I do wonder if they're benefiting from the on-site power generation of data centers, backup generation, something like that. Power solutions, power solutions. Exactly. I want to see what they sell right here. Choose from a variety of diesel, natural gas, and alternative fuel engines that deliver dependable power, high economic value. Huh. So yeah, I bet that for something that traditionally was only sold to cars, maybe they're benefiting from the data center industry. I don't know. So let's do Moeller Industries now. This is my most recent purchase, and they're part of if you look at any AI beneficiary stock on Friday, like look at this, Powell Industries was down 7, Comfort Systems was down 6, Amphenol down 4, AMD 4. MLI was no exception. So this one's on a nice downtrend, and I'm honestly glad that I can finally recommend a stock that's not extremely overvalued. So here's why I really like Moeller Industries. They're going to benefit from HVAC, construction of data centers, just the re-onshoring of construction back to America they benefit from. That's why we had the whole tariff thing. Everything's made in China or made in other countries, especially like with chips now. We're trying to be more rare earth mineral independent and manufacturing independent, especially if geopolitical stuff starts to escalate again. So this is a pure beneficiary of that. Nearly in every building, they literally started the copper tubing and piping industry They only traded a 15.8 forward PE. So that's why I think the risk to reward looks good at only a 14 forward PE, and how fast they're growing. Like their main piping systems that grew 18% year over year after grew 8. So there is some cyclicality. Like in 2023, it experienced a decline, but their growth is finally back, double digit growth, and they had a big beat on earnings. So they expected 169 mil in net income. They did 239, and that wasn't some one-time adjustment like accounting fluke. Even on the EBIT, earnings before interest taxes, they expected 214. They did 314. So really nice beat on that quarter specifically, and it was a margin expanding quarter. Here's how you can quickly tell if a company expands margins. Revenue grew 19, but net income grew by 51. That means the net margin grew by 27%. It went from a 15 to a 20. And here's another thing. If we just zoom out to net income over time, this is one of what you want to see. I know it was cyclical. Like in 2023, the growth kind of slowed down a little bit. Like the net income fell 20%, but now it's back to a record, and it's still well above their 2019 level. So in my opinion, like this is a pretty cool company. And another thing that takes a lot of risk off the table, because there are some risk factors, that they literally have zero debt. They are completely debt-free, 1.4 billion in cash, like the most cash they've ever had. They actually just did an acquisition too, so they would have even more cash, but I like that they're doing acquisitions, and you get a nice dividend. It's like a 1.2% dividend yield right now. So I'll do a quick little investor presentation on them. And so you get a 1.2% dividend yield. You get exposure to HVAC, copper. Here's what their global manufacturer, copper, brass, and aluminum products, with exposure to HVAC, plumbing, electrical, and industrial markets. Pretty cool. And literally zero debt. Huge free cash flow conversion. And when you have this good of metrics, this is what they've done historically: 22% average return on invested capital, 19% total shareholder returns every year, and only a 14x price to multiple. And they're either the number one or number two in their core products. They're literally the industry leader, for these copper products, serving all these different industries. And here's what they actually sell: piping systems, which has a 28% margin; industrial metals at a 10; climate solutions with HVAC valves, protection devices, brass fittings, high pressure components, 29% margin. They own like the only Canadian full copper manufacturing fab. So look at this: 30% of the revenue is HVAC. Plumbing is 42%. Electrical markets is 11%. I love that the three main businesses are, it's like this industry that's like AI proof almost, and almost should benefit from AI. Plumbing construction, HVAC construction, electrical markets. So pretty cool company. I won't spend too much more time on that one because I don't want to spend too much time, but I did just buy that one, and I am down 10% on my position because I literally just bought them like this past week. So they actually have a 1.24% dividend yield. So if you like dividend growth stocks, there you go. So let's do Road now, ROAD. So I used to own this stock, RIP. I used to own see, some of your biggest regrets in the market will be selling at a great stock. So Road right here is at $107 a share. I sold my shares at $26 a share. So I'd be up like 4x if I didn't sell my Road. But they literally do what their ticker symbol says. They construct roads, highways, stuff like that. They have public and private infrastructure projects with emphasis on highways, roads, bridges, airports, and commercial and residential development. So view investor relations. Yeah, let's go to their investor presentation. Or do they have one of those? I'm not seeing investor presentation here. Well, maybe just go to their main website right here. Yeah, we're going to decline the cookies. So Robinson Paving. So they own a bunch of different subsidiaries right here, like Fred Smith Construction. Oh yeah, view our companies. Let's see our family of companies. So basically all these different Sunbelt Asphalt. Huh. Interesting there. So anyway, lots of I wonder if other countries have a better growth exposure. So yeah, 100% of the revenue comes from the US. Basically a pure infrastructure build out play. And look at this right here. Revenue's growing very nicely. Revenue's up 34, after it grew 53, after it grew 14, after it grew 33. They're on a streak of growth. No wonder the stock is up 4x in just 3 years. And not just revenue, but it looks like the net income is at a record as well for their peak quarters. It's never been close to 56 mil in net income before, and they're consistently net income positive. Like the past 4 quarters, they've made net income every quarter. When they used to make money 2 quarters, then lose money that 1 quarter, used to be kind of choppy. Now it's consistent net income across the board. What's the valuation though? So they're trading at a 34 forward PE. So that's one thing you want to be cautious with, 34 times net income. But a very interesting construction company. Wow, net income's supposed to hit 75 million in 2 quarters. It's never been close to 75 million before. So that might be what the stock is pricing in right now. So yeah, they literally construct roads and highways and stuff, it looks like. Oh yeah, well check out InnoData too. Uh, um, Jersey Mike's has amazing subs. Yeah, I agree. At what price would you consider buying more InnoData? That's a good question. So this is FCF. That stands for free cash flow. That's what FCF stands for, if that's what you meant there. But yeah, here's InnoData right here. This is a really cool software company. The reason they gapped up on earnings is, well, they had phenomenal earnings, and they just got Palantir as a customer. Palantir is now agreeing to spend over $50 million a year on their services. This is a data labeling company. They basically help train LLMs. Their top 5 customers are literally Google, Meta, Amazon, Nvidia, and Microsoft. And now Palantir is a customer. So, I mean, if we zoom out, they've had a great, 5-year performance, but they are in a little downtrend this past couple weeks here. And here's why I believe analysts are wrong. Analysts say they trade at 65 times next year's net income. I believe they're wrong on these forecasts, especially off the quarter that they just gave. Analysts projected 76 million this quarter. They did 90 mil. And not just a beat on revenue, but net income. They expected 2.8, they did 14.8. And that wasn't some accounting fluke. That was real after paying taxes. Earnings before taxes and interest were 17 mil. So if they beat by this much this quarter, I almost bet they're going to beat huge the next 2 quarters in a row. And that's why you certainly don't want to sell out of this company. I'm almost certain for the next 2 quarters, they're going to crush earnings expectations because they just haven't updated them. So anyway, yeah, great company. They just had record revenue this quarter, and their growth is not done here. So it's just a very nice, growthy software company. Almost like they position them as the picks and shovels play. I've actually gone over. I've made a few dedicated. It was a long time ago when I first bought the stock, but I've done dedicated, like 2 dedicated videos on this company right here. Let me show you this super quick investor presentation because literally. Yeah, look, they have contracts with 5 of the Magnificent 7. So literally, everything ex Tesla and Apple are customers right here. I wonder, positioned as the data layer of generative AI. Yep. So any other thing? They've changed their investor website right here, but oh yeah, here's the TAM. Look at the market for enormous generative AI addressable market opportunity. Like here's 2026, we're at like a 566 mil. In 2030 mil, it's going to more than double. So this industry specifically is growing at a 50% CAGR. That's what their revenue is growing at. Anyway, pretty cool company. Let's see right here. Key highlights, full year highlights. So they have 82 mil of cash, 92% services. 22% organic revenue growth. Anyway, pretty cool. What is this? Full year 2026 guidance of 35% or more. I bet they're going to beat that. All right. Next up, let's see. These are some interesting names here. We'll come back to Uber because we already looked at them. Architecture is on a big downtrend. What's BYD? Hey, when you say BYD, are you talking about the car company or BYD Gaming? Let me know which one you're talking about. Because some people, when they say BYD, are talking about like the Chinese Tesla company. Cummins needs to get into nuclear. I wonder if they could do that. Interesting. CMI are doing green backup generators for data centers. You know what? That's probably why they're doing so well. You know what? I believe it. Oh, ACNR. Let's find it. Akinter. So I believe this was that consulting business that got crushed by AI or something. Is there any news? Akinter faces margin pressure from enterprise budgets shifting to AI spending. There you go. See that? So they're getting hurt by AI, but maybe the thing is, like at this cheap of a stock price, like maybe they've already fully priced in all the bad news. Maybe they've overly priced it in. So they announced results with 6% revenue growth, but announces a $9 billion acquisition for OT cybersecurity firms. So they're plan on targeting cybersecurity firms, Dragos, RunZero, and NetRise. So it looks like they're getting into the cybersecurity market. What is this right here? Middle East conflict resulted in $100 million revenue impact. So maybe the Middle East conflict is hurting them as well. Where's the revenue come from? So only 45% of it is from the US. Yeah, then EMEA and Asia Pacific areas. Okay. Here's why it's, it's not the end of the world yet. Like they're nowhere near losing money. That's the crazy thing. Like they're still making over 1 to like 2 billion of after-tax net income a quarter. And check out the net income forecast. Like next quarter, they still expect 1.95 bill, 2.4 billion the quarter after. So they only trade at literally a commodity multiple of a 9.5. This is like what an oil stock trades at, like ExxonMobil, 9.5 times forward PE. It's at that valuation where analysts aren't really expecting the stock to create or lose you any money. Interesting. But they still print, 2 billion net income a quarter, and you get a 4.6% dividend yield. But it might, so they're actually headquartered in Ireland. Their zip code is 2. They're headquartered in Dublin, Ireland. So I don't know, maybe, again, we kind of saw the news that maybe big tech firms are, what was the news exactly? Faces margin pressure as enterprise budgets shift to AI spending. Maybe I'm a big fan of cybersecurity, so maybe the cybersecurity business will bring back some growth. But $9 billion, what's the whole company worth? The whole company's worth $84 billion, so they're spending over 10% of what the whole company's worth buying these new companies. So there is some execution stuff to look out on there. All right. So, hey, Tingrika. Hey, I'm actually ending the TikTok stream. If you want, head over to the YouTube stream, but I'll check this out for you. Said thoughts on CCXI. Thank you. Churchill Capital. Oh, this is a blank check acquisition company. So yeah, let's go to their website right here. I wonder what they bought. So they have 2 employees. So basically what they do is just buy shares of companies on the public market or private market. I don't know what this company bought exactly. But maybe, so they own NVIDIA, SoftBank, Amazon, some stuff. What the Robotics Hub? Is that where robots go to? I see. All right. Anyway, something interesting there. Let's look at a different stock you said, though. You said ISRG. Actually, I'd love to cover this stock. So ISRG, and then we'll cover, we'll look at BYD, the car company, and we'll look at Coloplast. Hey, yeah, give me the ticker symbol. We'll find that stock. So here's ISRG. This is a great healthcare robotics company. They make like those MRI scanning devices, and then they service them as well. So there's no news around the stock, but as we can see, they're on this massive downtrend right here. I think the valuation is still a little high, but they deserve to be. I guess we'll figure this out because the forward PE is still kind of too high. So even on this massive dip that they've had, they still trade at 45 times next year's net income. But here's why they always trade expensive. I'll start with the best part first. They have no debt. They literally have absolutely no debt and 4.5 billion of cash. That cash isn't just sitting there doing nothing. They milk it in 1 to 3 week treasury bills, and they literally make 80 to 90 million of just interest on their cash a quarter. And that goes straight to their bottom line. Like it doesn't cost them any money. It's like 100% margin to just milk interest or your cash and interest. And check out the net income right here. The net income is literally the highest it's ever been. They're the most profitable quarter they've ever had. 826 mil in net income. And how about the free cash flow? Yeah, 800 mil of free cash flow, up 73% year over year. They crushed expectations as well. Analysts expected 660. They did 820. They beat for the past 3 quarters in a row. And on revenue, they expected 2.61. They did 2.77. So the stock isn't falling because they're missing on net income and missing on revenue. I think it's just like a healthy, it's getting to a more healthier valuation because they're still at a 45 forward PE. And before today, they were at like a 60 forward PE when they were up another 20%. So they're finally getting to a good deal. And let me show you the revenue breakdown. So yeah, they sell these medical instruments and accessories. That business grew 23% year over year, fastest growth rate on the screen. Then they also service these machines. The service revenue grew 19%, after grew 15, after grew 10. So this has such good fundamentals here where honestly, it's still worth putting on your watch list. Because to have no debt, have record net income, do share buybacks. Yeah, they also do big share buybacks. Well, not big. I mean, they bought back over 1% of the company this past year, which isn't much, but they're probably not doing crazy buybacks because the stock is still a little expensive. But anyway, very great company. I definitely put it on the watch list. So, okay, BYD, the car company. Yeah, this is basically Chinese Tesla stock right here. If we did not tariff Chinese cars, they would probably be all over the U.S. market because these BYDs, they can make these for $8,800, and in China they sell them for like $13K USD. They're for the price that they're honestly good. And if we didn't tariff them, they do. So BYD current stock is undervalued. Its dominant 30% market share in China's new energy vehicle market and strong financial health will drive long-term value growth, Morningstar saying. So automobiles and related products. So here's the net income forecast. We've converted it into US dollars. So they're supposed to make $1 billion next quarter, 1.85 billion the quarter after. So they're a profitable company, but yeah, dang, looks like it's a low margin kind of industry though. Like I look at that, like a 4%, 6% margin, kind of like a low single digit margin, but that's because they sell a commodity. Um, you get a nice dividend, a 1.88% dividend. Berkshire Hathaway, they don't own Tesla, but Berkshire Hathaway does own BYD stock, which is Warren Buffett's company. So yeah, China is 61% of the revenue, and overseas they're actually selling a lot of cars into Europe right now. Anyway, they're struggling just like Tesla is. Tesla, if we go to their car sales are actually doing really bad, and they've had huge margin declines on Tesla. Like Tesla used to have a respectable over 10% margin. Like look in 2022, 13, 15% net margin, and went from a 13% net margin to a low single digit 2, 3, 4% net margin. And that's why I don't understand how Tesla is so expensive when the fundamentals are genuinely declining, like even on operating profit. But Elon, anything around Elon will just have an insane valuation. That's I'd rather buy BYD than Tesla for sure. Okay, so what are your thoughts on Coloplast? I hope I can find that stock. I don't. Oh, it's actually an ADR, so we found it. I'm actually surprised. Okay, so unfortunately, they're at an all-time low right now. So I feel bad if you own this stock. So they're a Danish krone company, or will convert the currency to US dollars. Or no, they're headquartered. They're headquartered in Denmark. Chronic care, voice and respiratory care. So some sort of international healthcare company. No. So 2 million plus amount of people we help each year, 100 plus countries. So okay, so they do all this sort of healthcare. Wound and tissue repair, voice and respiratory care. So kind of all these industries. I wonder why the stock is struggling then. Let's go find out. So yeah, the US is only 23% of the revenue. So yeah, most of it is like internationally. So chronic care, interventional urology. Anyway, when we combine all the businesses together, revenue grew 9% year over year. So revenue was 1.1 billion, and they had a GAAP one-time adjustment. So they didn't actually lose 150 mil this quarter. They actually made 280, but they had some one-time adjustment that made them look like they lost 150 mil. Yeah, the net income forecast are actually negative. Like net income is supposed to go from 180 to 160. I mean, revenue, it's just a low growth story. I mean, they're still net income positive, but it looks like the business is just growing very slowly. 19 forward PE. Does Morningstar cover this one? Wow. Morningstar covers this stock. Now that Coloplast has already shifted most of its manufacturing to low-cost geographies, gains in gross margin are not so easy to achieve. Wound care portfolio is relatively limited, especially when compared to products from Smith & Nephew. If Amazon were to enter home health supply distribution, this could put price pressure on Coloplast. But the bulls are saying because of aging population in developed countries, its incidence on colorectal disease is growing independent of age. The purchase of is a leader in the emerging niche of fish skin processing for wound care. I've heard about that. Like you put like a salmon skin on your wound and it helps. The U.S. remains one of the largest astronomy care and continuous markets, and Coloplast has beefed up its footprint and made inroads into geographies, landing as GPO. Anyway, I wish I could give you better thoughts on them. Maybe something to look into. So Pulse said SMR. This is actually a small modular reactor company. This is actually one, I hate to say this, but I actually would not own this company. It's one of my least favorite ways to play nuclear. Like if you genuinely love the nuclear industry and you're bullish on it being the future, this is honestly, sadly, one of the worst plays. They don't own any, they have no They have no reactors. They're trying to build SMR, small modular reactors. If you didn't know, there's only two working SMRs in the world. Neither of them are in the US, and none are going to come online in the US until at very least 2030. And if we go to the revenue, I mean, the fundamentals have just deteriorated. They actually went from selling off some of their own assets. So this isn't even like real revenue. So the revenue this quarter was 560K. Revenue last quarter was 1.8 million. I mean, it's just such little revenue. And on this 500K of revenue, they lost 46 mil. They lost 60 mil last quarter, 500 mil, 40 mil, 30 mil. So they're burning a couple hundred mil a year. But they fortified their balance sheet from stock dilution, which is honestly smart because they know this. They diluted shareholders by over $1 billion the past 3 quarters. So I can see why the stock has done so bad. You own like 50% less of the company than you did a year ago. They lose an insane amount of net income, and it's okay to lose a lot of net income if your revenue is growing fastly. The revenue declined 95% year over year. So it's just a tough nuclear play to genuinely trust. Look at the net income forecast. They're supposed to lose 41 mil, 42 mil the quarter after. So they're losing hundreds of millions a year. It's a tough sell for me, especially at this super high market cap. So if you're genuinely a fan of a small or just nuclear in general, I'd go with the CEG. And this one makes money. It only trades at a 19.8 forward PE. They own over like 35, 36 nuclear reactors. They own over 30% of all the US's active nuclear reactors. It's the purest play. You get a nice dividend. They do share buybacks. They do acquisitions. They trade at a low valuation. So that's my favorite play. I've looked at every nuclear stock that exists as well, like Nano as well as Complete Junk. So yeah, Vistra Energy is a good one. But yeah, that's why I bought CEG. I do own them, so I might be biased. But yeah, the only thing that scares me is SMR. There's basically no revenue. They lose an insane amount of net income, and that's why I expect this doesn't just happen for no reason. There's a reason that 20% of all the shares of SMR are being shorted. That doesn't just happen if there's no bear case. There's a real bear thesis here. That's why 20% of all the shares are being shorted. Could be a fun short-term swing trade, day trade, but as a long-term buy and hold nuclear play, I actually don't see it. So what's up? Said, what are your thoughts on how? All right, Skull. All right, Skull Cat. I see what you're doing there. Hey, if you got a stock you want to look at, let me know though. Dexcom. Hey, yeah, what's Dexcom? If you have a stock, please, or I'll type it in for you. I got you. Dexcom. Will it load here? Well, hey, yeah, actually, you'll probably have to give me the ticker symbol. Unfortunately, we're trying. If you have a stock, please give me the ticker symbol and we'll find it for you. Oh, wait, it was just there. Dexcom. Oh, DXCM. Okay. All right. And then we'll look at BVS. I just found that stock really interesting, not invested. Oh, yeah, hey. Yeah, interesting. Coloplast was interesting there. So here's Dexcom stock right here. And actually, if you're on TikTok, I'm in the TikTok stream right now. So if you want to support me, please just type into YouTube Nathan Robert. You'll find the stream. But sadly, TikTok has just ruined my whole experience on TikTok. So please type into YouTube Nathan Robert and watch the stream from there if you want to help a brother out. Thanks for showing up. All right. So here is DXCM right here. So this company is a medical device company. So, or maybe we can go to their website right here. Oh, is that one of these glucose monitoring companies, I think? Yeah, so it's like these little patches. World's most powerful CGM system with best-in-class accuracy and growing ecosystem. Sending glucose numbers to your phone or receiver in real time, giving you better control over diabetes and health monitor. Okay, so anyway, the whole diabetes industry might be at risk because of the whole GLP-1 prescriptions, weight loss prescriptions, might make just less and less people having diabetes, which is, good. But probably not good for this stock right here. So Morningstar says the current price is undervalued. Persistent innovation in continuous glucose monitoring, expansion into the type 2 diabetes demographic, and the rollout of lower cost G7 sensors will drive long-term value growth for Dexcom. So they traded a 27 forward PE or 27 times next year's net income. US is 71% of the revenue. Yeah, the net income forecasts are great. They easily make a couple $100 million a quarter. They're supposed to make $230 million next quarter, $257 the quarter after. So they have great margins. Yeah, 16, 20% net margins, making a couple $100 million net income a quarter. Yeah, if we zoom out, actually, excluding the adjustments, they're the most profitable they have ever been by far. And that's despite the whole GLP-1, fear. So like fundamentals are still doing great. Net margin expanded, revenues up 15, net income's up 89. So, yeah, and maybe this continuous innovation into these other demographics could drive some more value for the stock. Very interesting there. All right. So, Garble said BVS stock. What's this one? BVS. And we'll look at some other ones. So here's Bioventus stock right here. They're a very tiny one, so they're only worth 800 mil. Okay, so some insider owns like 90 mil. Okay, so they're worth, yeah, $870 million. So pain treatments, surgical solutions, and restorative therapies. So it's another healthcare company in the medical industry, proprietary orthobiologic product for treatment of patients suffering with array of musculoskeletal conditions. Okay, well, let's go check out their website. Maybe we can get a better understanding. I won't spend too much time on this one because we've looked at a lot of healthcare companies. Completes divestiture of its advanced rehabilitation business. So they sold off a business. Okay, so as a leader of innovation of active healing and surgical with a comprehensive portfolio of clinically effective and cost-effective solutions for patients. Okay, well, let's see how the fundamentals are doing. So when we combine all the businesses together, the revenue growth has been a little slow. So like this quarter, revenue grew 6%. Last quarter only grew 2%, negative 0.2, negative 2, negative 4. So that's kind of low single digit, kind of doesn't beat inflation. When you average out the 4 quarters, the revenue, doesn't beat inflation. Like here's on an annual point of view for the past year. But it looks like the growth is starting to come back, 6.6% revenue growth. And it looks like they're getting net income positive for the first time. Yeah, literally for the first time ever, they're making net income. So they've made net income the past 4 quarters, and yeah, they've never made net income before today. So you're basically buying this company as they're getting net income positive for the first time ever. Interesting there. What is he saying? What is this comment right here? FDA clearances for 2 new PNS products. I guess this is what Bioventus receives FDA clearance for 2. Well, here's some random comment. I don't know if that's helpful. But interesting. It actually is probably worth putting on the watch list. I mean, that net income growth, like they're getting that income positive for the first time ever, that needs to be rewarded. But this very slow revenue growth is something to be cautious of. So, hey, what's up, Louise? What's up, everyone? Hey, I hope everyone's having a good Sunday and had a great 4th of July. So let's do the VGT ETF. So this is the Vanguard Information Technology. In the blue line, we have it overlaid versus the normal S&P 500. So historically, the Vanguard Information Technology ETF gives you better returns than the S&P 500. Specifically, look at this since the tariff dip down here. This one's done a lot better. I suppose it's because of Micron, but let's go check it out. So an ETF is just a basket of stocks. It's safer than buying one individual company because it diversifies you up for you. But yeah, it's like a pure QQQ play. Like in the QQQ and S&P, NVIDIA is like 8% of the ETF. NVIDIA is 16% of the ETF. So if you put $100 into this ETF, $16 of that goes straight to NVIDIA, 15 to Apple, 9 to Microsoft, then Broadcom. So notice there's no like Meta or Google. And then it's Broadcom, Micron, AMD, Intel, Cisco. So it's like a more like tech exposed, information technology ETF that historically has beat the S&P 500. So what do you think of silver? So yeah, SLV. This is the iShares Silver ETF right here. It actually looks pretty similar to the price of gold. So yeah, the precious metals, usually this is seen as like a safe haven asset. The war fears, peak tariff escalation issues were like a couple months ago. And that's when silver and gold were at their peak, when everything was like the end of the world, it felt like, So whenever we have a de-escalation, that isn't great for the price of silver. But anyway, sadly, historically, I don't think if you just buy silver, you're probably not going to beat the S&P 500 consistently. On the long run, you won't beat the S&P 500 just buying and holding like a precious metal commodity. But it should be a small part of your portfolio as a diversification hedge, as like a safe haven asset. Kind of like an oil, where you don't want to be all in oil stocks, but you want to still have a slight bit of oil just in case war fears escalate, Strait of Hormuz escalate, and you'll have that little hedge, Dave's been going crazy. Yo, this one I've been talking about. Well, it's been a while, but I talk about Dave and Sezzle a lot. SEZL and Dave is 2 cool fintech stocks. So if we look at this company, they're at this multi-year high right now. Here's why I'm honestly still bullish on this stock, even after this insane stock rally. that they've had, Dave, even after this rally, only trades at a 22 forward PE. So they only trade at 22 times next year's net income, even at this all-time high level price. So what that means in English is don't sell. There is still a lot of room for this company, I believe, to continue to climb higher. So that's why actually I did trim a little, but I'm not selling any more shares ever. I got 4 shares left, and I'm up 393% on them. They have been crazy good. Um, I bought them not even that long ago. I actually here. Would you buy a stock with this chart? Like here's where I bought them. Like the stock went from literally $5 to $94 in a year, and there's where's the buy order? I didn't feel great about it at the time. I bought, well, it was more shares at the time, but I bought all my shares on that day. Here's the chart I was looking at. Like people were calling me crazy to buy a chart that has already gone up so much, but I'm like, the fundamentals are still so good. They're probably going to continue to climb higher, and they just do. They're and only at a 22 forward PE, there's still upside. They just crush expectations and grow so fast. If we just go to revenue, lifeblood of the company, revenue's up 46% year over year, and the profits are also at a record. They're the most profitable they've ever been in terms of net income, free cash flow. The free cash flow is a beast on this company. Anyway, let's see what's next. How about Pinduoduo? What's up, Sure Shot? So Pinduoduo is actually Temu. So have you heard of Temu before, like that Chinese website that's like everything's $1 on there? This is their stock publicly traded. Usually Chinese stock, unfortunately, they're a Chinese ADR, so that kind of makes it uninvestable. Xi Jinping at the swipe of a finger can just destroy this company. France enacts law imposing fines on Temu and ultra-fast fashion retailers, bans advertising. Oh, like Temu, Shein, AliExpress imposes raising fines from 25 cents to 6 euros per item. Jeez. Well, anyway, I guess this brokerage right here is telling me there's some technical analysis here. There is some what is this? There's a bullish continuation wedge, and this says that there's a rise probability of a 94% chance, but that's of course all technicals. We like to judge a company off the fundamentals. So Morningstar says they're undervalued despite near-term margin pressures from heavy first-party investments. The robust network effect of its domestic platform and the rapid, adaptable global expansion of Temu will drive long-term value growth. So these Chinese stocks always trade really cheap. They only trade at 7.6 times net income. If Alibaba trades at like a 12, Chinese ADRs always trade super cheap because they're the regulatory environment and they're not from the US. But yeah, we've converted the currency to US dollars. They still print money. They're easily making like a couple billion. We've converted it from Japan or Chinese yuan. They easily make a couple billion of after-tax net income a quarter. No dividend on the company, but anyway, this is it is still hard to be bearish, but I just don't want to own anything Chinese. And Amazon, we actually got like an exclusive early access. Amazon is releasing something called Amazon Nova. It is the exact same thing as Temu. They only sell things for under $10 or less. They're making it separate from their main Amazon website because they don't want to dilute the brand and quality that Amazon already has. So Amazon's making something called Amazon Nova, which is actually a direct competitor to Temu. And that's just one of the Amazon projected to become the first company to reach 1 trillion in annual revenue. I believe it. Anyway, Amazon is just the best stock. If you like Temu, you also like Amazon. Great e-commerce play as well. So, what's up, Louise and Jesse? What are some of the companies you can invest in? Well, pretty much most companies you've heard of before, like Google, Meta, McDonald's, Constellation Energy, Netflix, Amazon, Coca-Cola. Invest in what you know, in my opinion. Not always, if you've heard of Ford before, it doesn't mean you should buy Ford. I actually would not own Ford. I think it's a bad stock that won't beat the S&P, but you want to own stocks and companies that you heard of before with great fundamentals like Amazon, like Netflix, like Coca-Cola, like Google that owns YouTube. All right. So, or NVIDIA, if you have an NVIDIA chip or an AMD chip, buy those stocks. So, yeah, Ryan, remind me to get back to SoFi. I want to come back to SoFi because we already looked at them. So someone said, though, can you take a look at NEM, company that uses AI for designing and maintaining buildings? Is that Newmont? Isn't this a gold? Well, actually, I don't know. I guess we're about to find out. Okay, can we please load here? NEM? I might have to reset the app real quick. Okay, here we go. Newmont. This is a gold stock. Yeah, so someone said, maybe I'm looking at the wrong ticker symbol, but he says, can you look at NEM? Company uses AI for designing and maintaining buildings. So here's the actual commodity of gold versus this stock right here. As you can see, it's pretty much exactly the same. Like, they rhyme together, and I'm pretty sure that's because Newmont is a company that owns a bunch of gold mines. Yes, they own the Nevada gold mines and all these different mines around the world that owns gold mines. So basically, if you want exposure to gold, but almost like a growthier way, it's like you get exposure to gold, but with a dividend. If you just own the commodity of gold, you don't really get a yield or anything. But this is a stock that owns a bunch of gold mines, and with gold at record prices or close to it, they can sell these for a high margin. You get over 1% of your money back in a dividend every year. 9.3 forward PE. Well, obviously a commodity multiple. Whenever companies in the commodity industry, they trade a low multiple. But interesting there. Newmont Gold. It's a different NEM. Really? Okay, let's see. Let me know. Is it an Australian company? Newmont Corp? Maybe you're talking about this one. It's Australian listed. So Newmont receives 500 million Canadian government support for Red Chris Block Cave project. What is that? I don't know. Well, let's go check out this company right here. Whoa. Okay, never mind. This is the exact same company. Sorry. Well, I tried to look for NEM, couldn't find it though, but I did check. So next up we see Ghost or ooh. Do you use Interactive Brokerage? No, I use Moomoo. It's a different brokerage. Actually, I use all these brokerages. I use Robinhood. I use Webull. They're all brokerages. They all ask for a bunch of information and send you tax forms. But if you're interested in investing and want to get a brokerage, in my opinion, I would get Moomoo. It's my favorite one. It's literally free, costs nothing, no fees at all. And it's the best app to actually analyze stocks on. And if you want to sign up for this brokerage, I actually have an affiliate link linked in bio if you want to check it out through that link. But you can just type into Google Moomoo, no pressure. But if you use that link and sign up, we both get like a free fractional stock or something. All right, so Supermicro Pulse said this company just got their headquarters literally invaded by the Taiwanese government. Taiwan authorities raid Supermicro Computer over alleged and illegal NVIDIA chip exports to China. So yeah, the CEO quit. This was this day back here. They were accused and found guilty of literally smuggling chips into China to prop up net margins. This was one of the worst management teams I've ever seen. I actually used to own Supermicro stock. Like back here, I was waiting this day. They were literally supposed to report earnings. It was 4:10. We're waiting for them to report earnings. They literally just didn't report earnings. And the market freaked out. They delayed it. They had to get whole new accounting teams. And here they are again, back at some shenanigans where Taiwan authorities literally raiding their offices. So Dell is taking huge market share because of this. But if analysts are simply right, it's honestly hard to be bearish. If analysts are correct, though, like they're supposed to make $420 million next quarter, $370 million of after-tax net income next quarter. If they're right, Supermicro literally trades at 10 times net income, or literally 10 times next year's net income, but it's a management trust issue. You know what I mean? And it's a kind of low margin commodity. Dell, whenever you buy NVIDIA chips, you hire Supermicro to basically just come install it for you. They already have the new infrastructure to install the new NVIDIA Vera Rubin chips. Same with Dell. So it's basically Dell and Supermicro that own the market. I'm just staying away from this one because I don't like the management. Plus, they just diluted you by 20%. But they said that's why the stock fell this day specifically. You own 20% less of the company than you did the previous day. But they say they're using this for good purposes. Anyway, I just stay away from that. But if analysts are right, though, at a 10 forward PE, honestly, it probably is undervalued, but I'm just kind of staying away. Dell is the one who literally, I was reading, like they literally took after the news and stuff, like literally are taking market share away from Supermicro Computer. Okay, next up I see, what do you think would be the next big trend after memory stocks for AI? I don't even know. Actually, right now there's a huge memory shortage. There's also a CPU shortage that AMD and Intel are benefiting from. Like AMD and Intel just in like 2 months ago were $200, or they both have like more than doubled. All right, so, hey, what's up, Isaiah? Are you investing in Sprouts Farmers Market now or Power Solutions? I do. Those are two of my big losers. I do own both of those. But I'm not buying more of either of those right now. Sprouts Farmers Market, I fear, is being out-innovated by Whole Foods and Amazon. What app is this? Hey, again, I'm on a brokerage. It's where you buy and sell stocks. They ask for a ton of information. If you want to get a brokerage, though, I have it linked in my bio there if you want to sign up for this brokerage called Moomoo. You can just type it in Google called Moomoo, though, and find the brokerage. Okay. Yeah, if you want to use my affiliate link, linked in bio. So someone said, look at Figma. That is literally the same thing as Adobe, or it's just a smaller Adobe. Funny story, Adobe tried to buy this company. They agreed to pay a 1 billion termination fee if they weren't allowed to acquire them. The EU regulators didn't allow Adobe to buy Figma, so Figma got a free $1 billion from Adobe, and then they IPO'd a couple months later. In my college, there's like whole classes that use Figma, their software and stuff. But this is one of the yeah, look how fast they grow. Like the lifeblood of the company, the revenue is up 46% year over year. After grew 46%, after grew 42%. So the fundamentals are flawless. They're still struggling with net income positivity though. Actually, I didn't know it was this bad. So I lost 140 mil, 200 mil, 1.1 billion. The real bad, yeah, they're supposed to lose 150 mil, 150 mil the next 2 quarters. That's actually very bad. That actually makes this one uninvestable almost. They are so far. I would rather buy Adobe. But basically, the fear is here. Basically, in 10 years from now, will we need Photoshop? Will we need Adobe and stuff? Because actually, this is more of an app. Like I know someone who used Figma to create an app on the App Store. So it's not just like it's a little more different than Adobe. They help create like phone apps and stuff. But the art fear is like, hey, in 10 years from now, will we need Adobe? Will we need Photoshop if we can just AI generate a logo or AI generate a thumbnail or something like that? And I heard someone say, no one says anymore when they see a fake image, they're like, hey, that looks photoshopped. No, people say that looks AI. Like they lost like the verb or the noun, like um people still say, actually that was the same with Twitter. That's why X is so stupid. They lost like people saying, oh, hey, tweet that, hey, retweet it. They're like, oh, we're calling it post now. Like Kleenex is a great example. Everyone says, can I get a Kleenex? That's just the name of a brand. Or like Google it. Okay, thoughts on Micron. Ooh, we'll come back to them. Figma's high risk. Yeah, they're still a little far away from profitability, but they could be interesting because again, the Figma revenue is up like 50% the past like super fast revenue growth. All right, Intuit, bro. So Intuit, this is another software company that's getting hurt by the AI thesis. So I don't know if you really want to trust AI to do your taxes, though. So this company owns TurboTax. They own QuickBooks for small, medium-sized businesses, DIY tax filers. They actually saw a sharp decline in their DIY tax filers. But honestly, I believe all the fears are fully priced in, especially now that they're this cheap. They're getting hurt by AI, but at this low valuation, I think they're overpricing it in too much. So Intuit trades at only a 14.8 forward PE or 14 times next year's net income. But consumers are 61% of their revenue right here. Wait, what does Morningstar have to say? Morningstar says they are undervalued, high switching costs within its core small business accounting software, and the expansion of AI-driven assisted tax filing will drive long-term value growth. Maybe AI tax filing they should benefit from that, but maybe it could lower margins if anyone can do it, So TurboTax could face material headwinds if government-sponsored free tax filing program gains traction. Other small business accounting software competitors like Xero are looking to expand in the US market, leading to competitive pressures on QuickBooks. Intuit's enterprise suite still in early stages of build-out process. So that's what the bears are saying, but here's what the bulls are saying. Synergies from Credit Karma and TurboTax should continue to deepen. Their enterprise suite powered by QuickBooks and MailChimp is a unique product that should drive Intuit's online ecosystem. Intuit's done-for-you products like TurboTax Live give the company additional runway to lift average revenue per customer. But I remember specifically the reason they gapped down on earnings is because the DIY tax filers there was a huge miss on that metric specifically for the most recent quarter. Anyway, that all being said, the fundamentals are so strong. I mean, obviously, that 1 quarter tax time is their 1 quarter where they make a ton of money every year. But even on the other quarters, they're growing it very fast. They're consistently making, billions in net income a year. It's really you buy the stock if you don't think they're going to get hurt by AI. And even if you think they're going to get hurt a little by AI, maybe that's fully priced in at this, multi-year low level 14 forward PE. So if you use QuickBooks, TurboTax, maybe buy the stock as well. But maybe could AI in 10 years, you just insert AI tracks everything you spend and auto does your taxes or something in 10 years from now. Who knows what the future is? But maybe they'll be the one to benefit from that. Oh, hey, yeah, try not to spam there in chat, bro. I want to try and get to all these stocks here. What app is that? Yeah, hey, again, I'm on a brokerage. If you want to get to, if you want to get the app I'm on, it's linked in bio. It's an app called Mumu. LinkedIn profile, like description there. So someone said, What was that stuff? Microsoft. I have not looked at this one. Let me get to Microsoft, and then I'll get to Iris Energy and Palo Alto Networks. I want to get to all these before I go. Oh, dang, I have to go in 12 minutes, but hey, if you're enjoying, please leave a like on the stream. I stream every Sunday at the same time. So here's Microsoft right here. Genuinely, you'll love my analysis on this one. Oh, by the way, yeah, Grain, I don't want to repeat that. If you want to support me, the only way to support me, I literally sell nothing. I have no course book. I don't coach. The only way to support me is to watch the stream from YouTube. And if you go to my YouTube stream, you can rewind it and hear what I just said. So yeah, if you just type into YouTube Nathan Robert, you'll find the stream. That is the only way to support me. TikTok's giving me issues. But here's Microsoft. This is the world's #1 software company, and that's why they're being hurt. We just look at any software stock like we just did, Adobe, Salesforce, they're all on this massive downtrend, and Microsoft is no exception because as the world's #1 software company, think Excel, PowerPoint, all that suite of products. It's Excel. That does for Microsoft over $120 billion of annual revenue a year. So the stock is down because they're categorized in the software sell-off category. But here's why Microsoft is the best positioned. They literally own 28% of OpenAI, which is ChatGPT. So if ChatGPT really takes over their software, they are hedged as the biggest owner of OpenAI. And also, if OpenAI or just any AI company takes over, Microsoft is the second world's largest cloud company. Right behind AWS is Microsoft Azure Cloud. This also does over $100 billion of annual revenue. And what do AI companies need? A ton of cloud. And Microsoft is the second largest cloud provider in the world, should be a huge beneficiary. Also, they own Xbox, they own LinkedIn, they own Minecraft, Activision, Blizzard. That's their more personal computing business. They are seeing, actually, because of this memory shortage, they're having to raise Xbox prices by like $150. The new iPhone's going to cost $200 more. Oh yeah, Microsoft raises Xbox Series prices by $100 due to memory chip shortage. It's not that could, hurt Xbox demand, but that wouldn't scare me out of Microsoft, especially when Microsoft trades at only a 20 forward PE. For the Mag 7 behemoth quality, Microsoft is the world's #1 software company, world's #2 cloud company, and a great AI company as a OpenAI and Copilot owner. Only a 20 forward PE seems very undervalued. Even Morningstar agrees. They say they're undervalued. Robust demand for Azure Cloud, driven by cloud expansions and AI workload surges, alongside its highly entrenched Office ecosystem, will drive long-term value growth. And the net income forecasts are phenomenal. They're supposed to make $31 billion net income next quarter, $34 billion the quarter after. And that's why I just purchased Microsoft a couple weeks ago for the first time ever. I don't got much. I only have 3 shares, but again, out of every stock, invest in what you use. Microsoft, I believe, long term, I would not be worried. I believe AI is actually going to benefit Word. Like, you use ChatGPT or whatever, it's not replacing Word and PowerPoint and Excel and spreadsheet and all that. I believe AI will enhance that. So anyway, that's kind of my thesis on Microsoft, and it's a great dividend growth stock. If you buy a share of Microsoft right now today, you get a 0.93% dividend yield. So you're getting close to 1% of your money back just in a dividend every year. And let's see what the bullish news is. I saw some news. Microsoft launches $2.5 billion AI service. Okay. Anthropic launches Claude models on Microsoft Azure. So not just OpenAI is on Azure Cloud, but even Anthropic, the other huge LLM model, Claude, is going on Microsoft's cloud. Microsoft backed OpenAI. Okay. Anyway, Microsoft to merge consumer enterprise Copilot into one application. All right. We'll look at a few more here. Then I sadly got to go in 10 minutes. All right. Next up. Oh yeah, PANW. I love cybersecurity, but I have not talked about cybersecurity lately because every single good high quality stock, even Fortinet, Cloudflare, Palo Alto Networks, CrowdStrike, they're all at ridiculously insane valuations. And this is what I've been saying a couple months ago. A couple months ago on this dip, I was like, and this was every software stock, out of every software sector to buy the dip on, cybersecurity, in my opinion, is the best one to buy the dip on, because I'm a believer that AI is actually gonna, hackers will use AI and get better at hacking, and the demand for cybersecurity should only go up in the future. Cyber attacks that's like the new future, So cybersecurity should only benefit. And Palo Alto is the one that serves over like 50% plus of the S&P 500. Is a huge beneficiary, but it's insanely overvalued at a 225 forward PE. But they have this really nice subscription business right here. 55% of the revenue is this, and check out the growth. Analysts love subscription models. It's all reoccurring, predictable. It was 1.63 billion, up 32% year over year, the fastest growth rate on the whole screen. And look at it on an annual basis. That's what you want to see if you're going to diamond hand a growth stock with a high forward PE and no dividend. You want to make sure they're growing their business very fast, and they definitely are. But unfortunately, the 200 forward PE is unbuyable. Looks like there's no new news on Palo Alto Networks, but and it's not just them. All great cybersecurity stocks are at an all-time high as well. So next up, we'll look at oh yeah, Iris Energy. This is a stock I would not own. This is a company that rents out GPUs, and actually mainly they just mine Bitcoin right now. So it's going to sound simple, but it really is this simple. All this company does is own an insane amount of NVIDIA GPUs. Right now, most of those GPUs just mine Bitcoin, and now instead of just mining Bitcoin with them, they're renting out the GPUs to cloud companies. So even 2026 Q3, still 77% of all this company's revenue is Bitcoin mining. But then they're now renting out GPUs to cloud companies. This is Q3. This is now 23% of their business. If we go just a couple quarters ago, that was only like 2% of the business. So they're growing that side of the business. But the unfortunate part is neither are profitable. This is the one sector of AI I would not want to own. Don't own CoreWeave, don't own Nebius, don't own Iris Energy, don't own APLD. And I've looked at all these in depth. I've spent hours on all of these stocks specifically. They all have terrible net income forecast and terrible free cash flow forecast. Like they're supposed to lose 117 mil next quarter, 128 mil in net income next quarter. This is the one part of AI that is money losing, the GPU rental business. Yeah, look at the free cash flows, huge negative free cash flows. So I didn't mean to be too bearish on that one. And also, NVIDIA literally just bought a stake into this company. That's why I'm also scared, because of the circular financing stuff that's happening. Here's what NVIDIA does. This is why they own CoreWeave. NVIDIA gives money to CoreWeave, and what does NVIDIA or CoreWeave do with all that money? They spend 100% of that money on NVIDIA chips, and that's the same thing that just happened with. That's why NVIDIA owns Nebius. That's why they own Iris Energy. That's why they own CoreWeave, and they just sold out of APLD. They're buying. They want to support their best customers who are propping up their orders. All right. But yeah, sadly, it's not just a them problem. If you look at CoreWeave or Nebius, they are nowhere near making any sort of money. Here's like Nebius, for example. They're supposed to lose 223 mil next quarter, 304 mil this quarter. And it says, like, investors are getting tricked right now. It says that Nebius this quarter made 620 million. They didn't actually. It was a total accounting fluke. They actually lost 128 mil. And same with this quarter back here. It says they made 580 million. No, they lost 111 mil that quarter. It was a gap accounting fluke trick to. Anyway, that all being said, these stocks could still do good through the end of the decade, but I'd rather buy NVIDIA. Or just I love the whole AI ecosystem. Instead of just owning NVIDIA, own the companies that do the complex MEP work. Comfort Systems that does the HVAC work, or Powell Industries that does the MEP, the complex mechanical and electrical construction for the data centers. Own Amphenol that supplies the copper cables to NVIDIA and Google TPUs. Own the companies that construct these data centers, like a Caterpillar and United Rentals. Own the companies that power data centers with nuclear, like CEG, that owns over 30% of all the US's active nuclear reactors. So I like the whole AI ecosystem, and ones that create actual net income and free cash flow. It's hard to value the companies with no forward PE or that lose a lot of net income. Do you remember the name? Hey, what's up, Hyperball? Oh no. All right, so what about? Dang, I gotta go in literally 2 minutes. I apologize. Hey, if you enjoyed though, please leave a like before you go. I stream every Sunday, this exact same time. And if you want to help me out, the best way is just type into YouTube Nathan Robert. You'll find my stream. Are you still holding Food2? Yeah, dude, Food2. That's the app I'm on right now. Here's actually all my holdings in here. Yeah, I'm down 22% on that company right now. Down 30% on Sprouts Farmers Market. Here's my biggest performance. So someone said Dave. Yeah, dude, Dave, JDDY. Dave has been doing really good. Same with Sezzle. Hey, yeah, no problem there, Brian. Thanks for the nice words. I appreciate you, though. Someone said I own QQQI and SPYI. So yeah, these are covered call ETFs. You buy this to maximize your dividend income. So these historically, don't beat, on a total return basis, they don't beat or outperform the underlying index, but you buy it because of the high yields. The QQQ is something you never want to sell calls on because you're for sure going to get called on it. But that's why the yield is so high. That's how they pay a 13% dividend yield. So basically you buy that to maximize your income, but you won't, there's a hidden opportunity cost, and it doesn't beat the S&P 500's 8% a year. It doesn't beat that, and so you're basically it's a tough sell, and then you're paying an insanely high expense ratio fee for something that historically, admittedly, from the top covered call people don't outperform the S&P 500. So you're buying something that doesn't give you 8% of your money back a year, and you're paying sometimes hopefully it's not 1%, a 0.68% expense ratio fee. It's a tough sell for me. But if you like income, that could be cool. So yeah, last stock, you know what? We'll do Meta. That was the very first stock we looked at 2 hours ago. We haven't looked at it since, and it'll be the very last stock we look at. I actually have to go right now. So if you did enjoy, please leave a like before you go. I sell nothing, just on here, give my opinion. The best way to support me is just check out my YouTube channel called Nathan Robert. Just type that into YouTube. So last stock we'll analyze is Meta right here. Meta is being sold off because they are being hurt for spending so much on AI. So Meta is spending crazy money on CapEx, but that's not scaring me out of Meta, especially now that Meta just announced they are going to get into the cloud business. They're a little late, but they're doing this because they're using a bunch of compute themselves, but they're saying any excess compute that we don't need, we're going to rent it out. And that same day, this exact moment, tanked CoreWeave, Nebius, and Iris Energy. On this exact moment news, Meta announced this, because this is new competition for all of them. All those stocks fell like 10% that exact moment. Actually, I made an announcement of that in the Discord that exact moment. Maybe I could pull that up. But anyway, if you like Nebius and CoreWeave, but want better fundamentals, check out Meta stock. But and you get some other great businesses. But anyway, Morningstar says they're undervalued and unmatched user scale for its family of apps, AI-driven improvements in ad monetization, and the potential to leverage this excess compute capacity will drive long-term value growth. And I totally agree. At only at 18 forward PE or 18 times net income, the risk to reward looks so fair. I don't see this Mag 7 behemoth Meta trading at a 16 forward PE or a 15. So what that means is the bottom is extremely close. Maybe we could fall another 5 to 10%, but if it falls more than that, I simply would not believe it. It's almost like impossible for this stock to fall 15%. But of course, now financial advice, you didn't hear that from me. Here's another thing. They have 3.54 billion daily active users, and they just announced that Threads, it's like this ex-competitor. Threads now has 500 million monthly active users. They're now introducing ads to Threads. They're now introducing ads onto WhatsApp after they acquired WhatsApp, and their original slogan was no games, no gimmicks, no ads ever. They're now introducing ads on WhatsApp, but hey, nice earnings tailwind for us as a shareholder. So here's the thing being questioned. Meta makes 20 to 24 billion a quarter. They're right now spending in CapEx 33 to 35 billion a quarter, and they just projected for the next 4 quarters in a row they're going to spend 30 billion a quarter. So they're spending a lot more than they're making, and so they have a net debt position for the first time ever. But that would not scare me out of Meta, because I'm a believer ads will make their ARPU. They're going to make more average revenue per user because of the ads. It should enhance, just like Morningstar said, their ad business. Revenue, the lifeblood of the company, grew 33% year over year, the fastest growth rate on the whole screen. 18 forward PE. That's why the risk to reward looks so fair. Let me check something real quick. Okay. Yeah, I do have to go, sadly. So anyway, that's why I think the risk to reward looks very fair on Meta, 18 forward PE. Down 8% on Nebius. Should I hold or sell it? I just wouldn't allocate any new money. Like if you're like a Nebius, CoreWeave, I would not allocate any new money into those stocks. But I don't know if I'd fully sell out of it right now. I'd slowly try and dollar cost average out of that stock, Someone said Oklo Discord link. Yeah, the Discord link's actually in the YouTube description. It's only in the YouTube description. That's the only thing. I remember, how I said I don't sell anything? I literally sell nothing. I don't coach. I don't do anything. I do technically have a Discord, but it's $1 to join, and I did that simply to prevent bots. So if you'd like to join my Discord, if you have any personal questions for me or just want a nice little community, you can join my Discord for $1, and it's also for the YouTube members. So if you become a YouTube member, you get permanent access to my Discord. So even if you cancel the YouTube membership the next month, you still stay permanently in my Discord. It's just a way as a thank you to the few people that want to support me, or you can just pay $1 permanent access to join the Discord. It's a nice little community. Everyone's so helpful and nice. And it's basically if you just want me to analyze a stock for you personally or a portfolio. But actually, I do got to go right now. Have a great rest of your day. I'm so sorry I have to go. I'm going to stream later tonight, potentially at 8 p.m. Hey, thanks again for everyone on the YouTube. I hope you had a great 4th of July. See ya, Ven. Oh, I'm so sorry, Michael Anthony. I have to go right now. I'd love to look at Pepsi. I'm so sorry. But Rubes, Ryan, Ven, all the YouTube members like Brian Paul, thank you very much. Pulse.